Hello everyone and welcome to this very important session where we discuss full SFM practical concepts, a full marathon revision based on charts. Now, as you can see, all of these topics which are practical topics we would be trying to cover over here. All key adjustments, formulae and important tips we will cover. For theory, you have a separate video, you can refer that. The chart notes over here, we'll be sharing this on our Telegram channel. You can download this if you need them from the Telegram channel. So let us get started. The first topic over here is valuation. It's an important 10 to 12 mark topic and there are a lot of concepts that we need to cover over here. To start with, we'll have bonds. Within bonds, you will have the bond valuation, the bond return, bond risk and strategies to manage bond risk. So how do you value a bond? Well, the value of a bond is a present value of future cash flows, which are in the form of interest as well as principal cash flows. The discount rate that you use for this purpose is usually the required rate of return that an investor expects to receive. If the valuation is to be done from the investor standpoint, if the valuation is to be done from the company, the issuer standpoint, how much is the issue price that the company should set, then the discount rate should be the rate which the company wants to offer to the investors. Now, sorry, this will help you in valuing a standard, straightforward, regular bond. In certain questions, there may be complexities where you might be asked to find the value of a semi-annual bond or a quarterly bond where the cash flows are not annual, in which case you will have to make certain adjustments. That is, if it's a 5-year bond, that is 10 half years, 5 into 2, that is 10 half years will be taken, and if the coupon rate, let's say, is 10%, you'll say 10% is per annum, which means 5% for 6 months, required rate is 12% per annum, that is 6%, let us say, for 6 months, and using these revised numbers for 6 months, you'll try to find the value of a bond. Same is the case for quarterly, where you will have to do the adjustment by 4 instead of 2. Next, you have perpetual bond. Perpetual bond is something which is very similar to an equity share, just that the interest in case of a bond does not grow. The dividend keeps on growing, interest remains constant, and hence the value is interest divided by the required rate of return in case of a perpetual bond. Next, we go to bond return. There are 3 important measures of bond return. First is the current yield, second is realized yield, and third is yield to maturity. Current yield is the most simplest version, which is interest upon the market price. This ignores the time value. It also ignores the capital appreciation that can be received at the end, and hence it is not as popular. Realized yield, on the other hand, tries to consider the time value and the capital appreciation, though not in the most efficient way. So like if it's a 5-year bond which you are buying, let us say, at 90 rupees today, it gives you a coupon of 10 rupees in each of the years and then redeems at 100, in which case the realized yield would say, well, 90 rupees today becomes 10 plus 10 plus 10 plus 10 plus 10 over 5 years plus 100. That is a total of 150 at the end of the 5th year. And the rate which equates 90 today to 150 after 5 years is the realized yield. As you could have clearly figured out, this is not the best way because you are ignoring the fact that 10 rupees of interest received in the first year is not equivalent to 10 rupees of interest received in the 4th year. Again, this is not as popular. So which is the most popular and the important method? Well, that is yield to maturity. Yield to maturity refers to the return that an investor gets if he were to purchase the bond at today's price and if he were to hold this bond up to maturity. This is calculated by the trial and error method and using interpolation in the most accurate way. Like you do IRR in case of capital budgeting projects, YTM is the IRR of the bond. If you are running out of time, you can do it approximately as well, where you take the interest plus the capital appreciation per annum on an average divided by the average price, which will give you an approximate price, which is a good starting point for doing the trial and error workings. Another concept which is there refers to forward rates, which you do in a lot more detail when you even do interest rate management. This is the rate which is expected to prevail in one of the future years. For example, you have been told that the yield to maturity of a 2-year bond is 12% per annum and of a 1-year bond is 10% per annum, which means if the question asks you to find the return for the second year, not over 2 years, for the second year, that is a forward rate, which is typically calculated as 1 plus YTM, that is 1 plus YTM of the 2-year bond, so 1 plus 0.12 raised to 2 equals 1 plus, let us say, 0.1 for the first year into 1 plus, let's say, X for the second year. So that will give you the rate of a return for the second year, which is also called as forward rate, which is helpful in interest rate management chapter as well. Next, you move on to bond risk. There are 3 main measures of bond risk. There is the Machiavelli's duration, modified duration and convexity. Machiavelli's duration is a measure which is a time-based weighted average, taking present value of cash flows as a weight. So you will calculate the Machiavelli's duration as summation of T into PV/CI upon summation of PV of all CI. Now, Machiavelli's duration is measured in years and it loosely refers to as a discounted payback period or the average due date. That is, the bond is going to pay you amounts at various dates. If instead of paying all of these amounts at different dates, if it has to pay one single amount at a particular date, which date that should be? Well, that is the Machiavelli's duration. As it is intuitive, the further that date, the more is the risk. The closer that date, lesser is the risk. And as a result, higher the Machiavelli's duration, higher the risk. Lower the Machiavelli's duration, lower the risk. Why do we calculate Machiavelli's duration? Well, so that we can try to establish a relationship between changes in interest rate and the bond price. As you would be aware, the market interest rate and bond price have an inverse relationship. That is, if the market interest rate goes up, bond price goes down and vice versa. However, by how much will it go up or how much will it go down is a question which we don't know. Like for equity shares, beta gives you the answer. For bonds, modified duration gives you this answer. So modified duration measures the magnitude of a change in the bond price in response to a 1% change in interest rate. So if the modified duration, for example, which is calculated as the Machiavelli's duration into 1 plus the existing YTM. Let us say the modified duration, the Machiavelli's duration is, for example, 4 and the discounted today is, let's say, 10%. So 4 divided by 1.1 comes to 3.63 approximately. That means if the market rate of interest falls by 1%, then the bond price is expected to go up by 3.63% on an average. This is very important, the modified duration. However, there's another concept where one would say that, well, as the market interest rate keeps on changing, the modified duration itself can keep on changing. The rate of this change is measured by a number called as convexity. Now, what is convexity? Loosely speaking, in convexity, we say that the actual change in price is not linear or straight as predicted by duration. So duration would say, well, that if the interest rate goes down by 1%, the price will increase by 3.63%. If the interest rate goes up by 1%, the price will decrease by 3.63%. Similarly, if the interest rate goes up by 5%, then the price should decrease by 3.63 into 5 as per duration. But that is not the case because the curve is convex in shape. You can try to find the present values, actual. So for example, you can try to find a value by taking the discount rate at 10%, then at 15%, and then at, for example, 5%. So there's a gap of 5%. So what will be the value, for example, at 15%? What will be the value at 5%? And then minus 2 into the value at 10%. So ideally, if the change is linear, hypothetically, one can say that if the value that I started with was 100 and if the change is linear, then probably the upper value will go to 115, the lower value will go down to 85, and hence there will be no change. So over here, this seems to be huge. So over here, one can say that, okay, if the change was in fact linear, then my change may be, for example, exactly 15 rupees up and down, but that will not necessarily be the case. It might happen that this will go up to 117 and this will go down to 83, and hence one can say that, okay, 117 plus 83 minus 200, no, this is also kind of linear only, so this is, let's say, 87. So this is, let's say, 117 plus 87 minus 200. So basically 4 is the reason of difference. Ideally, if it is going up by 17, it should also go down by 17. No, it is going down by 13 only. And as a result, that 4 rupees, as you can see, is the base on which convexity is calculated. You take that in the numerator, and then the denominator you will have 2 into VO into the change in YTM squared, because convexity is supposed to be a second derivative. As in, I mean, this is very complex, very difficult to do it in such a short span, but nevertheless, as interest rate changes, bond price changes due to the Machiavelli's duration, first impact. As duration changes, price will again change, the second impact. So that is why we take YTM squared. So over here, like in Machiavelli duration, we take YTM, here we take YTM squared, just for your knowledge base. So this is about convexity. Next, you look at bond strategies. Now, this is where you get your intuitive understanding on what actions should you actually take. So, if let us say the market interest rate is expected to fall, bond prices are going to go up. So, you should ideally put your money where the bond prices are going to go up the maximum, that is a longer duration bonds. Whereas, if the market interest rates are expected to increase, the bond prices are expected to fall, then you will want to minimize your losses and you will try to put your money in shorter duration bonds and exit the longer duration bonds. So, if you will buy longer duration bonds in case interest rates are expected to fall, buy shorter duration bonds in case interest rates are expected to rise. Another popular type of question which Institute loves asking is a bond refinancing question, where there is an existing bond and we are contemplating making a new bond issue and figuring out whether it is advantageous or not. For this, you will have to do a analysis very similar to capital budgeting or NPV type of analysis, where you will have to try to look at the cash flows that you will generate from the existing bond, let's say at the existing rate, versus the new bond at the new rate. Also, the new bond will come attached with costs like flotation cost, there may be call premiums on redemption, etc., which has to be considered. Similarly, the tax savings on the new flotation cost as well as the unamortized old flotation cost also has to be considered. In some of these bond refinancing questions, Institute does not give you the discount rate. If it does not give you the discount rate, then the current post-tax cost of debt should be taken as a discount factor. So, if the current interest rate is 10% and the tax rate is 3%, 10 into 1 minus 0.3, that is 7% will be your discount rate. Then you have a concept of immunization. As the name goes, immunization is like protection. So, as bond, like banks who have assets and liabilities which are affected by interest rates, or pension funds who have assets and liabilities which are affected by interest rates, they will be subjected to interest rate changes, and to protect them from interest rate movements, you can do an action which is like immunization. Immunization just means that the duration of a portfolio of assets should equal to the duration of portfolio of your liabilities. At such a point, your portfolio is considered to be immunized. If at a later date there are certain changes that happen, Institute can ask you a question where you might have to again determine your strategy in order to again immunize your portfolio if the balance has been disturbed. Okay. This takes care of the section of valuation of bonds. Next, we go to the valuation of equity. In equity, the difference between bond and equity is that in case of equity, we get dividend, in case of bonds, we get interest. Bonds typically are for a limited tenure, whereas equity cash flows continue up to perpetuity. And hence, in order to value equity, we need a special formula which is used in the form of Gordon's formula, which can also be called as a constant growth model, dividend discount model, or the Gordon's growth formula, where we measure the price of a share as P0 equals D1 by KE minus G, where D1 is a dividend which is for the next year, KE is the required rate of return, which is typically calculated using CAPM, if not possible then Gordon, if not possible then using the earnings yield, that is E divided by price, or lastly using dividend yield, and G is equal to growth, which is R into B, that is return on equity, into B, that is the retention ratio, which is 1 minus the payout ratio. Now, this formula can work if there is a single growth rate. However, in most of your exam questions, you might have different growth phases. Like in the first 5 years, the growth rate might be different, and after 5 years, that is from 6th year up to perpetuity, the growth rate might be different. In which case, you will use the multi-stage model, which is more important in my opinion from an exam standpoint. What do you do in a multi-stage model? You will first chalk out the dividend for the first 5 years and try to find their present values. The value of a share is the present value of all future dividends. You have taken the first 5 years. Then dividend from year 6 up to perpetuity. Well, you will say that since they are growing at constant rate, you can take D6 by KE minus G. D6 upon KE minus G will give you P5. Like D1 by KE minus G gives you P0. And as a result, you will say that, okay, if I receive the dividends for 5 years, and theoretically, if I had to sell the share at the end of the 5th year, how much will I get? Well, I will get based on the present value of future cash flows. That is D6 up to perpetuity, dividends. And as a result, you will have the price at the end of year 5, which is to be taken, and the present value of all of these. So, first 5 years dividends as well as the price at the end of the 5th year will give you the price of the share today. So, this is multi-stage growth. Now, this is taking dividend as a base. Now, a big criticism about dividend is that dividend by default is considered to be discretionary, and as a result it may not be the best barometer to measure the value of a share, and as a result we try to improvise and we look at an alternative to dividend, that is we look at free cash flows. Now free cash flows can be cash flows which are freely available to be distributed. Well, to whom? Well, to the providers of capital. If the providers of capital are debt and equity both, we say that this is free cash flow to the firm. If the providers of capital are considered to be only equity, we say it is free cash flow to equity. Now instead of taking dividend, we can take free cash flow, and using free cash flow we can find the value. Now how will we find the free cash flow? Well, FCFF is a pool of money which is available for debt and equity both, and hence it is calculated as PAT plus depreciation plus interest into 1 minus T. Why? Because you need to find a pool which is available for debt and equity both, and hence you need to add interest and also reverse the tax savings if any on interest. This will help you calculating, let's say, the cash flow from operations. However, that is not freely available. You have to still keep aside money for your fixed capital investments. You also have to keep aside money for your working capital. So minus increase in fixed assets minus increase in working capital. This will typically give you the free cash flow to firm. Obviously, we have assumed that we'll have to deploy money for fixed assets, and hence we subtract. In rare cases, if I am selling fixed assets, that will give me a positive cash. I will add. If I'm getting money out of working capital, I'm releasing my working capital, I'll have to add. However, generally there's an increase in fixed assets, which is like capex, capital expenditure, or an increase in working capital, which we subtract. We don't touch the borrowings over here because you need to find a pool of money which is available for debt and equity both. So borrowings taken or repaid will not be adjusted here. On the other hand, if you're looking at FCFE, free cash flow to equity, we will do largely the similar working. That is, you start at PAT, you add back depreciation, but you don't add back interest because PAT is after interest and free cash flow to equity is after deducting interest. So no separate adjustment done for the same. Minus still fixed capital investment, minus still working capital investment. However, you also have to adjust the borrowings because you need to find a pool of money which is available for equity only, which means you have to consider the fact that borrowings may have to be repaid or new borrowings might have been taken. And hence, considering all of that, you will find FCFE. Now, in order to do valuation, you have to discount this. FCFE belonging to equity, and hence the discount rate should be KE. FCFF belonging to debt and equity both, and hence the discount rate over here should be WACC or KO. Okay. Next, there are some other alternative methods which are also possible for the purpose of valuation, which can be earnings yield method, not a very popular method, but instead of taking dividend, instead of taking free cash flow, you take earnings. So even by K minus G, or the P multiple approach where you take EPS into the implied PE. In either of these cases, as per ICAI solutions that are there, the KE in these cases is taken as ROE. So your actual rate of return is assumed to be the required rate of return as per ICAI solutions in both of these cases. Okay, now when we are looking at implied P is 1 minus or 1 upon the KE. So typically when you calculate KE, one of the methods to calculate KE is the earnings yield method, that is earnings by price. If you take earnings in the denominator, that is price 1 upon price divided by earnings, that is your implied P as per ICAI solutions here. The yield method is also one of the methods possible on which there's one sum where you take the yield, which is the return which is measured usually as PAT minus preference dividend divided by the share capital. However, if that data is not available, yield can also be calculated based on a specific formula given in the question. So you will say actual yield upon the adjusted expected yield into the paid up value per share. So for example, if your actual yield percentage comes up to be 15%, whereas the expected comes up to be 10%, then if your share has a paid up value of 10 rupees, it commands, it's like a cross multiplication, it commands a premium, because for every 1 rupee in the industry people are able to earn 10%, you are able to earn 15%, and hence you command a premium. So if you are earning 15% on every 1 rupee, the value of your share should be 15 rupees. Then there is Walter's model, which you might have done in your Inter-C as well, which was largely a method used for dividend policy decisions. But nevertheless, if you had to consider this, Walter's model does not really intend to act as a very good valuation model. It intends to guide you more so for the appropriate dividend policy. Having said that, the formula for Walter's model would be the price equals, you will take the dividend plus the retained earnings, that is earnings minus dividend, into R upon KE. So over here, the relationship between R and KE is the heart of the Walter's model divided by KE. So basically this formula says that whenever the R is greater than KE, that is your actual rate of return is greater than what is required, you should invest money in the company, not give out dividend. If R is less than KE, you should give out dividend. That will result in maximization of wealth. post-issue market price approach, sometimes you have a lot of data about new fundraises or new project that the company will take, in which case you will try to find the post-issue market capitalization and divide by the post-issue number of shares in order to find the post-market price per share. So these are various methods for equity valuation. There's also a section on efficient market hypothesis, which was given by Eugene Fama. So Eugene Fama said that the market structure can be studied based on whether it is weak form efficient, semi-strong form efficient, or strong form efficient. This depends on how efficient your market is. So if your prices prevailing today reflect patterns, datas of past prices and volume, your market is supposed to be weak form efficient. If your prices today reflect not only the past price and volume data, but also reflect the publicly available information, market is supposed to be semi-strong efficient. Whereas if your market is so efficient that it reflects the past price and volume data like technical analysis, also publicly available information like the fundamental analysis, and also the privately available information like insider information, then the market is strong form. Really good and developed markets are also in the semi-strong phase because insider trading is banned. Strong form is generally supposed, is just in theory, does not really exist. Semi-strong form does exist in really developed markets. Weak form efficient means, it kind of says that technical analysis is useless. Past data of prices will not really be able to help you on returns. You'll have to do fundamental analysis. There are a few tests which can be asked in the exam for the purpose of doing efficient market hypothesis, whether to see whether the market is efficient market, weak form efficient or not. One of them is runs test. Another is autocorrelation test. These are fairly statistical workings. You can refer the theory for the same. That is a runs test. There's one standard question, and the autocorrelation test also there's a single question. I think it's a Jan 21 paper. You can refer this for your understanding. Achha, next you have technical analysis. Technical analysis, there are various methods like resistance levels, support levels, candlestick, so many approaches for technical analysis. But remember, in your entire syllabus, you largely focus on fundamental analysis, that is discounted cash flow or valuation using Gordon's formula, etc. But you should have a broad understanding of technical analysis. One of the methods which Institute asks is the exponential moving average. It had even come recently in the exam. It has also come earlier. So you can focus on exponential moving average, which is one of the technical analysis method where you have 3 steps. Remember those 3 steps where you do the exponent adjustment, which is the current day price minus EMA of the previous day into the exponent factor. Factor is usually given. If it is not given, you calculate it as 2 upon n plus 1. Once you find the exponent adjustment, you find the current day EMA, which is the EMA of the previous day plus or minus the exponent adjustment, and you keep on doing this exercise. You will be able to do it in every day except for the first day where you might face a bit of a difficulty, in which case you can take a starting point as the 30-day simple moving average for those shares or any other number as well, and then you can keep on repeating these steps. Okay, then there are a few simple concepts in this section which is involving, let's say, rights. There are 2 concepts that you have to remember. One is calculation of the theoretical X rights or post rights price, which is nothing but the weighted average price. It is taking the number of shares that you have pre-rights into the pre-rights price plus the shares on right into the rights price upon the total shares post the rights. That will give you the post rights price. Sometimes a question may also ask you to find the value of rights alone. So if you have to renounce and sell the rights alone, then it is the difference between the X rights price and the rights issue price. That is the value at which the right alone can potentially be sold. Next, you go to buyback. Buyback is usually done if the company has surplus cash and it wants to send a signal to the investors that the management believes that the share is undervalued. Buyback really helps the investors because you will utilize your idle cash. You will buy back your shares, and hence the denominator in the EPS calculation falls. So usually after buyback, the post buyback EPS will be higher because it is surplus cash. It did not materially contribute anything to the profits. Your profits in the numerator remain largely the same, but your number of shares in the denominator falls, and hence the EPS increases. P ratio even remaining constant, your market price will increase. So over here, your post buyback PAT upon post buyback shares will be giving you the post buyback EPS, which will generally be higher, and post buyback market price will be the post buyback EPS into the post buyback P, which is assumed to be same. In certain cases, it is even higher. Achha. Next, there are questions which institute loves asking about convertibles. Now in convertibles you can get a 4 or 6 or 8 mark question where small terms may be asked, like what is the conversion value. Conversion value is a value that you will get if the bond were to be converted into equity shares, which is usually the conversion ratio into the market price of equity share. Next is the conversion premium, which is nothing but the conversion value minus the market value minus the conversion value. So whatever is the market value of the bond minus the conversion value will give you the conversion premium. This can be done in percentage, per share, per bond basis as well. Then there is the straight value. Straight value is nothing but the value of the bond is kept as it is, straight, which is the present value of future interest and principal payments. Conversion parity price is the price which the share has to reach in order to attain parity. It's like the market conversion price. It is the indirect price you are paying for a share, which is the market price of the bond divided by the conversion ratio. Then there can be downside risk, that is if the equity share becomes worthless, still the bond continues as it is. So the downside risk is calculated as the market price of the bond minus the straight value. So even if the equity share becomes worthless, the bond will come down to the straight value. So that is the market, the downside risk. Then there is income differential, that is the income that you will be earning if the bond continues as a bond minus the income if it was to be converted into shares. So how much additional income are you earning as a bond as compared to a share, and this will help you in calculating a premium payback period, which is a conversion premium upon favorable income differential. So you are paying a premium to acquire a convertible bond, but at the same time you are getting additional income because the bond is giving you more interest than a share, in which case how many years will it take for the conversion premium to be recovered? This is a premium payback period. These terms will require practice, but I'm just glancing through these terms. And the last part of this chapter will involve money market, which is typically short-term market instruments, which can be call money, which is a very short duration, around 14 days, treasury bills which are issued by the government up to 364 days, commercial paper which are issued by companies like Reliance, etc., high net worth corporates, certificates of deposit which are issued by banks, or repo, reverse repo transactions which are entered into by banks, borrowers, and let us say the RBI or two parties, where there is an arrangement to sell and then buy back at a pre-designated price. In a lot of these questions, you will be asked to calculate something called as annualized yield or a bond equivalent yield, which is calculated as F, which is a face value, for example, which is 100, minus P, which may be the issue price, maybe something like 96, upon 96, because that is what the company is going to get. It does not pay interest because only for, let's say, it is issued for 181 days or 6 months. Then we'll say rather than paying interest, we'll just issue the bond at 96 and then redeem it at 100. Then what is the rate? Into, let's say, 365 by 181, or you can do 12 by 6 depending on how the data is given. If it is given in days, you can take 365 by days, or in months, then you can take 12 by the number of months. So this will be, for example, 4 is the cost that you are paying for getting 96 rupees into 100 into 12 by 6, which will come to approximately 8.33%, which is the bond equivalent yield or the annualized return. Sometimes the question can also be asking you to find the effective return, in which case you will have to consider the effect of compounding as well. So you might say 1 plus 0.0833 divided by 2 raised to 2, because on a year there will be compounding effects as well. But in general, bond equivalent yield will kind of work. So this takes care of the discussion about valuation. Next, you go to the chapter on mergers. Now, this is a relatively easier reading and a relatively lighter one, very scoring as well. At the beginning, there's a lot of theory involving the various types of mergers, like what is a horizontal merger, that is between two competitors, or a vertical merger across the supply chain between suppliers or customers, or a conglomerate merger into different businesses, or even something like a reverse merger where a smaller company is acquiring a bigger one, or an unlisted company is acquiring a listed one, etc. The important part of the chapter starts when you try to calculate the post-merger EPS and then try to use that information to calculate the post-merger market price. So the post-merger EPS is typically, earnings per share, is calculated by taking the total of pre-merger PATs, profit after tax. So we say that the post-merger EPS is the sum total of the pre-merger profits after tax. Even if there's no synergy, the two businesses will still continue. Divide by the post-merger number of shares. However, what if there are synergies? Then apart from the pre-merger PAT of the acquirer plus the pre-merger PAT of the target, you will also take the synergies in the numerator and then divide it by the post-merger number of shares. That will give you the post-merger EPS. Now, usually this post-merger EPS is going to be used in order to calculate post-merger market price, but EPS into the PE ratio will give you the post-merger market price. Now, PE ratio can either be assumed to be the same as the acquirer. That is, we believe that the acquirer's brand name, goodwill, etc., reputation processes can be used, and the earnings of the target will also be rated based on the P multiple of the acquirer. So you take the post-merger EPS into the P ratio of the acquirer to find the post-merger market price, or alternatively, there are two relatively big companies, different sectors, etc., in which case the valuation will be done based on the respective P multiples only, and hence you can also take the weighted average P. That is, you can say that the P multiple of the acquirer into the total PAT of the acquirer plus the P multiple of the target into the total PAT of the target divided by the total total earnings. So that will be the weighted average PE. If nothing is given, well, institute typically follows the approach 1 where it assumes a P multiple to remain constant. So typically we do the valuation as post-merger EPS into post-merger P, provided data to calculate post-merger market price is not available in any other alternative way. So the best way typically is the Gordon's formula, for which you need the dividend divided by the required rate of return minus the growth. So if the growth is given both pre and post the merger, then we should avoid using the post-merger EPS into post-merger MPS calculation. In fact, in such cases, we will try to find the post-merger market price as the post-merger market cap divided by the post-merger number of shares. And the post-merger market cap can be calculated by taking the price of the acquirer into the number of shares of the acquirer plus the price of the target into the number of shares of the target, and the price in such cases will be calculated based on the growth rates which are expected to prevail after the merger. So the growth rates after merger are, let us say, higher, then the expected value will also be higher. If the growth rates are lower, then the expected value will also be lower. So considering the impact of different growth rates, there are good questions, I think, of BM and WA, of I think in our material, even in the institute's material, there is BCD and AFC limited. There are a couple of very good questions on this, and I would strongly recommend you go through them. Though they are not as popular in the exams as compared to just the direct EPS into P, if it comes, you should be aware that you should be applying growth rates. If different growth rates are given, you have to apply a different method to find the post-merger market price. Then you have to figure out the exchange ratio. Usually exchange ratio is the ratio which is calculated as a factor of the target upon factor of the acquirer. So for example, if you take market price as a base and target's market price is, for example, 100, acquirer's market price is, let's say, 50, then a target will say, well, my share is 100 rupees, your share is 50 rupees. When we do a share swap, you need to give me 2 of your shares for 1 of my shares. So it is market price of the target, that is 100, upon market price of the acquirer, that is 50. That is 2:1 will be your agreed swap ratio if it is based on market price. Now there can be various factors like earnings per share, market price, book value per share, intrinsic value per share, which are all favorable financial factors, as in higher the better, in which case the exchange ratio will always be the factor of the target upon factor of the acquirer. However, in certain cases, the exchange ratio may also be based on an adverse factor, like for example NPA, non-performing asset. So when you're looking at an NPA or a non-performing asset, the lower the better. And hence, if there's a bank which has an NPA of 20% and another bank, let's say Target has an NPA of 20% and the acquirer has an NPA of only 5%, then acquirer's shares are more valuable. But if you do 20% upon 5%, it will give you a 4:1 ratio, whereas you are saying that for every 1 share of the target, you get 4 shares of the acquirer. That's wrong. Target has an inferior share because it has a 20% NPA, and hence the ratio should be calculated as the NPA of the acquirer upon NPA of the target. So in case of an adverse financial factor like an NPA, it will be acquirer by target. In other factors, it will be target by acquirer. One of the most popular ways in which institute loves asking you questions is it will tell you to calculate this swap ratio by 3 or 4 different methods based on EPS, MPS, intrinsic value, and then it will give you weights, and based on those weights you will have to calculate the weighted average swap ratio based on which the exchange will happen. Okay. Also, one more thing that you have to remember in merger questions is the institute might sometimes ask you that you have to determine exchange ratio in such a way that the EPS remains the same or market price remains the same. Remember, if you want to keep EPS same, the exchange ratio has to be based on EPS. If you want to be market price the same, exchange ratio has to be based on market price. In certain questions, you might also be asked to do something called as impact analysis. That is, you will try to be commenting on whether the shareholders of the acquirer are better off or worse off, or the shareholders of the target are better off or worse off. If nothing is given, you will do this impact analysis based on market price, where you will compare the post-merger market price with the pre-merger market price of the acquirer shareholders, and you will do the same exercise for the target. But while doing it for the target, you remember that pre-merger, you had 1 share of the target. If the exchange ratio is 0.5:1, post-merger, you'll have 1 share of the acquirer. No, you'll have just 0.5 share of the acquirer, and hence whatever is the post-merger market price into 0.5 will give you the equivalent comparable share to find the true impact. So impact analysis also comes. Next, in certain questions, you might be asked to calculate premium. Premium refers to the excess payment that the acquirer is making for the purpose of acquiring target's shares. In case of a cash acquisition, the premium can be calculated as the cash which is paid minus the pre-merger market cap of the target. In case of a share swap, the premium can be calculated as a post-merger market price into the number of shares which are issued to the target's shareholders minus the pre-merger market cap of the target. So over here, premium is a part of the gain which is shared by part of the gain on the merger, which is taken up by the target shareholders. The gain on the merger is calculated as the value of the combined entity, acquirer and target, minus the value of the acquirer minus the value of the target. That will give you the gain on the merger overall. A part of this gain may be shared by the acquirer shareholders, a part of it may be to the target shareholders, depending on the exchange ratio. Now, certain questions require you to calculate something called as maximum purchase price, which is usually calculated using the discounted cash flow or DCF method. If you are acquiring just a minority stake, then the maximum purchase price is calculated directly by using Gordon's formula. There's nothing much over there because you do get no other benefits other than the dividend or the cash flows that you're going to get from the share. However, if you're acquiring majority stake, then you will obviously continue to get the dividends, or more appropriately the free cash flows, based on what you want to distribute. So you will take the present value of all future dividends based on the dividend policy that you want to follow, plus the present value of synergies, that is cost savings if any, that you generate, plus the present value on the sale of unrequired assets or liabilities that you might also get. So all of these put together will, and if there is any liabilities that you have to settle of the other party, you will subtract the present value of the liabilities that you are taking over as well. And after all of that, what you get is the maximum purchase price. If you have subtracted debt as well, that gives you the maximum purchase price for equity. If you have kept debt separately, then this will give you the maximum purchase price of the enterprise or the firm, as the case may be. Now, this is evaluation of merger. Should you go ahead with the merger? Well, you will compare the maximum purchase price with the consideration that is demanded. So if the maximum purchase price that you are willing to pay is 500 rupees and the other party is demanding 400, then you will be willing to go ahead with the merger at 400. But if the maximum purchase price that you are willing is only 300, whereas the price demanded is 400, then the merger will not go through. Next, you have alternative valuation methods, which are largely 3 categories. There is comparable approach, where you take the EPS of your company and multiply it with the PE ratio of a similar comparable company or an industry. So like if you are a retail company, you will look at companies like DMart, Shoppers Stop, etc. Try to find their PE multiples and multiply it by your EPS to find your values. This can be using PE ratio, EV by EBITDA ratio, EV by sales ratio, any ratio depending on the sector. Second is the precedent transaction analysis, where instead of looking at the current PE multiple, you look at the PE multiple in a recent merger transaction. So if in an airline industry, Tata has acquired Air India, then I will try to find a ratio, EV by EBITDA ratio for Air India, and considering that if I am also an airline company, I will look at the multiple. I look at my valuation based on the multiple given over there as well, hypothetically. Last is the sum of the parts valuation. Now, this is very suitable for companies or businesses which are like conglomerates, like Mahindra, like Reliance, who are into multiple businesses. So it is next to impossible to find a direct comparable for them. And as a result, for every segment or every division that they have, you will find a separate comparable and then find the value of each division. And the value of Mahindra will be the sum total of the value of each of their individual divisions, that is sum of, that is total of all the individual parts. Okay, next, in case of mergers, you also have questions involving economic value added, which is also there in corporate valuation and various other parts of your syllabus. Economic value added is more of an accounting concept in my opinion, but it is there in your SFM, so we kind of study that as well. EVA is a licensed I think, formula or a patented formula by a company called as Thomson or Stern, where they've tried to find the economic profit. Economic profit is calculated as economic value added is calculated as the NOPAT, that is net operating profit after tax, minus the invested capital or capital employed into the weighted average cost of capital. What is the essence of this formula? The essence over here is we're trying to find the accounting profit available for debt and equity both, and comparing it with the profit that the investors could have earned in the next best use. So I've invested the capital in your business, you have given me a return, but had I invested somewhere else as well, I would have gotten the minimum required rate of return, that is WACC. So how much have you been able to give me over and above that? That is a true value addition, economic value added. How do you calculate NOPAT? NOPAT is calculated as EBIT into 1 minus T, or it is calculated as PAT plus interest into 1 minus T. Either ways. How do you calculate capital employed or invested capital? That is calculated as your debt funds plus equity funds plus reserves minus fictitious assets of any. So you take debt and equity both. Also, if there are certain unrecognized assets, they should also be considered because they have contributed to your NOPAT, but they are not appearing in your books, like patents which you may not have registered. The value of them should also be considered. That is your invested capital, and you will compare it with the weighted average cost of capital, WACC, which is the cost of debt into the weight of debt plus cost of equity into weight of equity. If nothing is known, you can take the book value weights. If cost of debt is to be calculated, it is interest into 1 minus T. Cost of equity can be calculated using CAPM. So if EVA comes, it's a fairly easy question. You should try to solve it, and that takes care of mergers largely. Next we can go to the chapter on portfolio. So next we go to portfolio. This is a very formula driven chapter, but very scoring as well, because the moment you get used to the formulas, the chapter kind of sails through fairly easily. We have tried to discuss the concept of all the formulas when we have done this, but as of now we'll try to focus on understanding as well as remembering them again. So what is portfolio? Well, portfolio is a combination of securities. Portfolio managers can be like mutual fund managers, hedge fund managers, etc., which have to look at not just a single security but a combination of them. So what are the things that they need to measure? Well, every portfolio manager will be juggling between risk and return. So the objective of a portfolio manager is to either maximize his return at a given level of risk or minimize his risk at a given level of return. So it is necessary that the manager should be able to to calculate the risk and the return. So the return is calculated for a single security as P1 minus P0 plus D upon P0 into 100, where P1 is the price at the end of the first year, P0 is the price today, and D is like the dividend or distributions or the cash flows during the year. If this is for a period which is greater than 1 year, you can use simple interest concepts, like you can do into, let's say if it's for 3 years, into 1 by 3. Or if it is for less than 1 year, you can annualize it. So you can take, if it is a return for 6 months, so if it's a price after 6 months is given, you want to find a return which is percentage per annum, you can do price after 6 months minus the price today plus the dividend during 6 months upon P0 into 100, and then do into 12 by 6. So this is called as annualized return, which is used extensively in the mutual fund chapter as well. So this will give you the return for a single security. Similarly, you will also have to find a risk for a single security, and the best way to measure risk is standard deviation. You can have other measures as well, like range, etc., but standard deviation is the best measure. Standard deviation is calculated as the square root of summation of x minus x bar the whole square divided by n. In case probabilities are given, it is calculated as under the root summation of p into x minus x bar the whole squared, technically divided by summation of p, but since summation of p is equal to 1, that gives you the formula of under the root summation of p into x minus x bar the whole squared, which is the formula for measuring risk. This is for a single security. Now if you move into the portfolio setup, the portfolio return is calculated as a weighted average return. So if it's a 2 security portfolio, the return of the portfolio xy is the weight of x into the return of x plus the weight of y into return of y. If it's a 3 security portfolio, then let's say return of xyz, similarly for x and y, plus the weight of z into return of z, where the weights are the amounts invested, if it's the first year return, or if it's a multi-period return, in which case the weights are the value of these investments at the beginning, the total value of these investments, that is the price into the number of shares at the beginning of the measurement period or the beginning of the year. Now the challenge arises when you're trying to measure portfolio standard deviation or portfolio risk, which is measured by a slightly different formula, where you do, let's say this is variance square root is the standard deviation, but it is measured as the entire term, square root of weight of x squared into standard deviation of x squared plus weight of y squared into standard deviation of y squared plus 2 times weight of x, weight of y, standard deviation x, standard deviation y into the correlation of xy. This is a formula which is very similar to a plus b the whole squared, that is a squared plus b squared plus 2ab. However, because over here the variables are standard deviation, and standard deviation can never be negative. The way standard deviation is structured, it is squared and then square rooted. It cannot be negative, but the risk can offset each other. Like there are two companies, one is in the automobile industry, one is in the steel industry. If the steel price goes up, the steel company will do well. The automobile company which uses steel as an input will have a lower return, and hence the risk gets counterbalanced. However, standard deviation at both places is positive, and hence we need to bring in correlation. So we need to bring in correlation as well in this working. So how do you calculate correlation? Well, correlation is calculated as covariance of x and y upon standard deviation of x into standard deviation of y. Okay, so that leads you to another problem. How do you calculate covariance? Well, covariance is a combined variance. What is variance? Before you do square root in this standard deviation working, so this is a variance, the squared term. If you square root it, for example, it becomes standard deviation. So over here, if you want to do covariance, so you will have x and y, variance of x and y. Typically, variance is x minus x bar the whole square divided by n, that is x minus x bar into x minus x bar divided by n. Now, if you want to do covariance, then x minus x bar ke badle you will replace the second x minus x bar by y minus y bar. So covariance is summation of x minus x bar into y minus y bar divided by n. So this is covariance. Covariance, remember, can be positive or negative as well. In case probabilities are there, covariances will be calculated as summation of p into x minus x bar into y minus y bar. Okay, so these are statistical terms, you need to remember them. There are also a couple of things that you need to be aware in this section. One is theory of dominance. In case of theory of dominance, you will select securities which give you a higher return at the same level of risk. You will select the securities which have the highest return, eliminate the others. Or if securities are having the same level of risk, you will or securities are having the same level of return, you will select the security with the minimum risk, you will eliminate the others. Or securities which are having a higher return at a lower risk, you will keep them, and the other securities you can eliminate. If you want to select just one of these securities, you can also look at various performance evaluation ratios like coefficient of determination, Sharpe ratio, etc. to figure out which security to select. Lastly, there is a concept of minimum variance portfolio which can apply for two security portfolios, where you can find the weight that you should have in, let us say, a portfolio of two securities. Let's say we have X and Y. At what weight should you invest in X so that the portfolio weight is a minimum? So this is calculated as a weight of X equals a variance of Y. For taking X, you will take Y as a base, variance of Y minus covariance XY upon variance of X plus variance of Y minus 2 times covariance of XY. Just remember, for finding the weight of X, you will have to take the variance of Y, and for finding the variance weight of Y, you can take the variance of X. Alternatively, you can also say that the weight of Y is 1 minus weight of X. Now, this is a formula which is not as extensively used because it ignores the return. It just focuses on getting the lowest risk, but you also have to consider the return. So it can be a good starting point for constructing your two security portfolio, but other than that, it does not really give you the logical end. A few other cases you might also have to come across, like what if there's a 3 security portfolio, in which case the formula will be very similar for portfolio risk as a plus b plus c the whole square, that is a squared plus b squared plus 2ab, that is for a plus b the whole squared. But if it is a plus b plus c the whole squared, that is a squared plus b squared plus c squared plus 2ab plus 2bc plus 2ac. So you'll have 3 covariance terms over here, one for a and b, one for b and c, and one then for a and c. If it is a 4 security portfolio, as you can visualize, there will be more covariance terms. Okay, next you go, so this was what we had discussed earlier. This is a theory which was given by Harry Markowitz, who focused largely on standard deviation. Then comes the era of William Sharpe, where Sharpe says that total risk is not the best barometer to measure the required rate of return. Total risk is to be broken up, as per William Sharpe, into systematic and unsystematic risks. Systematic risk refers to the risk which is inherent in the market, which cannot be removed or eliminated by diversification, like the GDP falling, wars happening, tax rates changing. These are all systematic risks. However, unsystematic risks are those risks which can be done away, diversified, like death of a CEO or let us say labor strike in a factory. These can be diversified away. Sharpe says that an investor should be compensated for bearing only the systematic risk and not the total risk, and hence he devises a new measure of risk which is called as beta. Beta is referred to be a measure for systematic risk in a portfolio, and William Sharpe says that the required rate of return should be based on the systematic risk that the investor bears, which is based on beta, and hence when he develops CAPM, he uses beta as a measure of risk. CAPM, capital asset pricing model, says that KE or required rate of return equals to the RF, that is the risk-free rate, plus RM, that is the return on the market index like Nifty, minus RF into beta. Beta over here is a measure of systematic risk. How do you calculate beta? Well, beta is calculated by using, let us say, correlation. So you can say correlation of X with the market into the standard deviation of X upon standard deviation of market, or it can also be calculated using covariance, that is covariance of XM upon the standard deviation squared of X. Either of these formula. There is also a regression formula which is possible, but technically they should be giving you the same result, either of the formulas that you use. Now, when we look at the beta to be a measure of systematic risk, if one says that I want to measure systematic risk, how can that be? Well, technically that is the numerator of beta. So over here, what is beta? Beta is the risk of your security relative to that of the market. So when you look at the beta, the numerator of beta is the correlation of the security with the market into the standard deviation of the security. This is the numerator of beta upon standard deviation of M. Okay, what I can do is, I can say that, well, I'm saying that this is the risk of your security relative to that of the market. Denominator means the market risk, but numerator means the risk of your security. In fact, that is, once you multiply the correlation, the numerator becomes the systematic risk of your security, and hence this should give you the systematic risk. Okay. Alternatively, I can also take this standard deviation M on the other side, and hence mention that beta can your systematic risk can also be equal to standard deviation M into the beta, or it can be correlation of the security with the market into the standard deviation of the security. However, in a lot of questions, you will be asked to calculate systematic risk as well as unsystematic risk. Now, the problem is unsystematic risk cannot be calculated through a formula. It has to be a balancing figure. So, whatever is total risk minus the systematic will give you unsystematic. And as a result, in order to calculate unsystematic risk, you will have to do everything in squared terms. Like over here, your total risk will also be in squared terms, systematic risk will also be in squared terms, and hence the unsystematic risk that you will get will also be in squared terms. Well, why? Well, it is because when you look at 25, let us say that is the total risk in squared terms, and then you do 9 and 16. 25 is equal to 9 plus 16, perfect. So if you square root it, this will be square rooted totally. Now, if you do square root of 25, that is 5, and 9 plus 16 is equal to 25, that is also equal to 5, no problem. However, but if you make an error that you square root 9, which is, let us say, the systematic risk, and then square root 16, then you will get a wrong answer. You will get something like this, which is not equal. And this is something that you must have studied in elementary school. But nevertheless, the reason why you see institute keeping systematic and unsystematic risk in squared terms is because unsystematic risk is calculated as total, let us say 25, minus systematic, which is 9, and hence 16 is the unsystematic risk. If you then want to square root, you can do that after taking the balancing figure, otherwise you will not get the right answer. The square root of unsystematic risk is called as random error. Okay, now that takes care of systematic and unsystematic risk. It takes care of beta, CAPM. Then there are a few lines. There can be something called as the securities market line, which is a graphical presentation of CAPM, where you have return on one side and beta, that is a systematic risk, on the other side. You can have capital market line, where you have the return on one side and the standard deviation on the other side. And you can also have something called as characteristic line. Now, when we look at characteristic line looks at the characteristic or quality of beta. Capital market line, security market line is fairly easy. You take return on one side and beta in case of capital market line, standard deviation in case of beta in case of securities market line, standard deviation in case of capital market line. But when you look at characteristics line, I will put the return of the security on one side and return on the market on the other side. So I'm trying to find a characteristic on how well my beta can predict the return. Now, how do you calculate characteristic line? You calculate it as x is equal to alpha plus beta m, where alpha is equal to x bar minus beta m bar. So you are generally not asked to do any graphical plotting. So if you have to calculate the characteristic line, you will have to calculate the beta. Then using that beta, you also have to calculate alpha, and whatever alpha and beta you get, you substitute, and that will give you the equation of a line x is equal to a plus by, or x is equal to alpha plus beta market. So that is your characteristic line. Next, you have the concept of portfolio beta. Like you have portfolio return, you have portfolio standard deviation, you also have portfolio beta, that is the weight of security x into beta of security x plus weight of security y into beta of security y, and that will give you the portfolio beta of xy. Now, before you proceed, a few important things that you should be aware. Like there's a risk-free security. Risk-free security has standard deviation of 0 because it is risk-free. There's no risk. It has beta also of 0. It has correlation with everything else also of 0 because it will not move. So sometimes when you have to calculate portfolio beta, you have also been told that what will happen if you add a risk-free security. Well, risk-free security may have a weight in your portfolio, but its beta will necessarily be 0. Okay. Next, you have portfolio evaluation measures or performance evaluation measures. This is largely and extensively used in the mutual fund chapter. So there are 3 performance evaluation measures. There is the Sharpe ratio, Turner ratio, and Jensen's alpha. Sharpe ratio is calculated as the return of the portfolio minus the risk-free rate upon standard deviation. Remember, Sharpe has invented beta, but he believes that for performance evaluation, you should take standard deviation in the denominator. The Turner ratio, where you take the same numerator, return of the security or portfolio minus the risk-free rate, but now you take beta, and then Jensen's alpha, where you take the actual return and compare it with the required return using CAPM, that is KE. Sir, why does Sharpe take standard deviation in the denominator? Because Sharpe over here wants to evaluate a fund manager. Till now, Sharpe has been assuming that the investor is efficient and hence is diversified. But what if the investor is not? If the investor is not diversified, the standard deviation will be higher. And as a result, Sharpe says that you have to take standard deviation in the denominator. So if the investor is efficiently diversified, the unsystematic risk must have been removed and hence standard deviation would be lower. But if he is not efficiently diversified, then the investor should be fund manager should be penalized. And as a result, there will be a lower Sharpe ratio because the standard deviation will be higher. So among the 3, the best measure of evaluation is the Sharpe ratio. Then there is something called as a Sharpe's optimal portfolio. Now this is something which is, I mean, it has not come in the exam in the past, but if it comes, it is very calculative. There are a few steps, you'll have to remember that, where if there is a universe of securities, let's say 7 securities given, you will have to calculate Turner ratio for each of them, then rank these securities in the descending order of the Turner ratios. The highest comes first, lowest comes last, and then you will calculate cutoff points for each securities. Now cutoff points is calculated by a slightly complicated formula, that is variance of market into the cumulative of Rx minus Rf upon the unsystematic risk into the beta upon 1 plus the variance of the market into cumulative of the beta squared x upon the unsystematic risk. Now this is, if you have not done this earlier, forget it. I mean, you will need some practice on this. We have done 2 sums on this in our material. If you have done this, just go through those and proceed. Otherwise it's fairly complicated. Calculate cutoff points at each level. Once you calculate the cutoff point, you select the highest cutoff point, and these are the securities. So let's say the highest cutoff point comes at 0.4, then these are the first 4 securities are to be selected in your portfolio. Now the question might go ahead and even ask you to calculate weights, for which you will need to calculate a separate Z factor. Z factor for a particular security is the beta of that security upon the unsystematic risk of that security into the Turner ratio of that security minus the final cutoff point. That will give you the Z factor for one security. You will have to do the Z factors for all the 4 securities and then try to find the weight as Z of 1 upon Z of 1 plus Z of 2 plus Z of 3 plus Z of 4. So you will take the proportionate Z, which will be the weights. Now this is complex. If you have done that, just quite quickly glance through and proceed. Next, you have arbitrage pricing theory, APT, which is developed by various people including Stephen Ross, who said that, well, CAPM is a good theory, gives good concepts, however it focuses the required return on only one factor, which is the market. However, there can be various macroeconomic factors which can affect not just the market, it can be currencies, it can be GDP, it can be the market, it can be various things, inflation, interest rate, etc., oil prices, and hence you should try to find the return by multi-factors and not just a single factor. So the KE over here will be the risk-free rate plus the risk premium, which is also called as lambda of factor 1 into beta of factor 1 plus the risk premium of factor 2 into the beta of factor 2, and so on, depending on the number of factors. Now this makes the formula open-ended, and hence it is not as extensively used because it is an open-ended formula. So over here, though theoretically very sound, because of the open-endedness in the formula on selection of these factors, formula is not very frequently used. But sir, how will we calculate the factors? Well, factors can be calculated as a risk premium. One of the approaches is you can take the return of factor 1, like return of oil prices minus the risk-free rate, will give you the premium. Or you can also take the surprise element, where you take the actual and compare it with the expected. So either of these can work. Depending on the data available in the question, you will solve for the lambda values. You can also be asked to calculate portfolio beta over here, but remember, if there are 3 factors, for example, there will be 3 separate portfolio betas. Earlier you had a single portfolio beta because you had a single factor, single beta against the market. But here, if you have 3 factors, then there will be 3 different portfolio betas. Okay. The last part over here would be, in certain cases, you might be asked to do a private company valuation. Now, the valuation of a private company is based on the present value of future cash flows. So, you'll have to estimate the future cash flows, but again, you'll have to discount them. And for discounting, the best method to calculate the discount rate is the CAPM, which is RF plus RM minus RF. Things going smooth till now into beta. Beta is possible for a listed company, but we don't have beta for a private company. And as a result, you will have to figure out or estimate the beta of a private company, which can be done by doing 3 steps. First, you identify a proxy company. So if you are Flipkart, you can identify a proxy company, for example, someone like Amazon, and you can try to find the beta for Amazon. For example, let us assume Amazon was listed in India as well for simplicity. You can try to find the beta for Amazon, the equity beta for Amazon, or let's say Parle-G and Britannia. So Parle is unlisted, Britannia is listed. You can take Britannia as a proxy to Parle, and hence you can try to find the beta for Britannia. So this is the beta for equity shares of Britannia, and equity shares of Britannia, remember, bear the operating risk of the biscuit business as well as the financial risk that Britannia may not be able to pay debt. So the operating risk of Parle and Britannia is the same, the risk of the biscuit business. However, Britannia might have a lot of debt, Parle may have lower debt, or vice versa, and hence you can't just assume that Britannia's beta is equal to your Parle's beta. So you will find Britannia's beta, which is the levered beta, or beta considering leverage, Britannia's debt to equity. So you will first find the proxy company's beta and then employ a process whereby you will try to find the ungeared beta or unlevered beta by using the weighted average formula, like the cost of WACC is the weight of debt into the cost of debt plus weight of equity into cost of equity. Similarly, the asset beta will be the beta of debt into the weight of debt plus beta of equity into the weight of equity. Now, beta of debt is typically 0 and hence can be ignored. So your ungeared beta, unlevered beta, asset beta can be the beta unlevered equals to the beta of equity for Britannia into equity of Britannia upon debt plus equity of Britannia. If there is tax rate, then with the D you do 1 minus T. Once you do this, this will give you the beta of the assets of the industry. However, Parle also has its own debt, and hence you will relever this beta based on your debt. So this is called as relevered beta or levered beta or the equity beta, where you will employ the same formula. To be honest, this formula appears to be different, but it is just a rearrangement. So what you have done over here is you have taken equity on the other side and this on the other side. So you would see beta unlevered into equity plus D into 1 minus T upon equity. So you have just rearranged this. But over here you will take Parle's debt to equity ratio. Pele, you had taken Britannia's debt to equity ratio. So to summarize, in private company valuation, you will first find the proxy company's equity beta, then find the asset beta, which is assumed to be the same for both the companies, and then using that same asset beta, you find the equity beta of our entity, and once you do that, you can use the beta that you have derived in the CAPM formula. So that takes care of the private company valuation, and then you can move on to the next chapter, which is on mutual funds. Now this is a relatively easy chapter and it is an extension of portfolio. So ideally you should finish portfolio and then do mutual funds. There are two main types of mutual funds. There is the open-ended mutual funds, which are open for entry and exit whenever the investor desires, and the close-ended mutual funds, which have an offer period during which you can subscribe. After that, these units will get listed and you can buy and sell on the stock exchange, but you cannot go to the issuer and claim a redemption or take a new issue. Now, if it's an open-ended mutual fund, which is open for entry and exit whenever the investor wants, then at what price will the entry and exit will happen? Well, the price at which it happens is called as the net asset value, or NAV. How do you calculate NAV? Well, you will take the fair value of the investments that a mutual fund has on a daily basis, add to that all the other assets like cash, like any receivable, like dividend receivable, subtract liabilities, any payables or fund management charges payable, etc., which will give you the net assets of a mutual fund, divided by the number of units. Number of units, remember, can also go in decimals, and this will give you the NAV per unit. NAV can keep on changing, and every new issue or every new issue of units will happen at the NAV at the prevailing date, and any redemption will also be done based on the NAV at the prevailing date. Institute has asked you various questions on NAV calculation, where they will tell you about let's say the cost at which the shares were purchased, then what is the price today, or they will give you beta, or they will give you sector prices, and based on that you can try to find what is the market value of equity. There can be various adjustments given for cash as well, like you have spent money for expenses, you have received money on new issue, etc., and you can find the closing cash balance. There might also be certain distributions like dividends that you are paying off, and NAV calculations may need to be done. Now, there would be questions which involve return of mutual fund calculations. This is one of the most popular questions. The return over here is very similar to the return in case of portfolio, that is P1 minus P0 plus D upon P0 into 100. But in portfolio, typically the questions come on an annual return basis. However, in mutual funds, the questions will involve return for a mutual fund investment for, let's say, 4 months, or return on a mutual fund investment for, let us say, 4 years. In which case, a very popular method is called as the annualized yield or annualized return, where you take NAV, for example, after 4 months, minus NAV at 0.0 plus distribution during those 4 months upon NAV at 0.0. This will give you the percentage return for a holding period, that is 4 months. However, if you want to find the annualized return, you will have to do into 12 divided by 4. That will give you the return for the per annum basis. If this was 4 years instead of 4 months, you will take NAV after 4 years. That is after 48 months, and then at the end into 12 by 48 or into 1 by 4, which will give you the percentage per annum return. You don't need to use logarithms or compound interest. Institute does simple interest, and that will work. Now, this is the best way to calculate return in case of a regular mutual fund which distributes dividend in cash. However, in a lot of mutual funds, there is a dividend reinvestment option, whereby the unit holder is permitted to reinvest the dividend that is distributed at the NAV on the dividend date. So here the investor does not get a cash flow. Instead, the dividend is reinvested and the investor gets units. In which case, how will you calculate return? Remember, in case of dividend reinvestment plans, returns have to be calculated on a total basis. Why? Because, well, the NAV at the start may be 10, NAV at the end may be 11. So apparently there is a return of only 1 because you have not received any cash dividend. However, the units at the beginning may be 1000, and now the units may be, let us say, you might have received another 150 units. Your unit at the end may be 1150. So your return is calculated on the total number of units into the NAV at the end minus the total units into the NAV at the start. You will not separately add any dividend because the dividend is in form of units and it has already been added into this total calculation. Whenever there is a bonus plan or a dividend reinvestment plan, your return has to be calculated on a total basis and not on a percentage or not on a per unit basis. A bonus scheme is a scheme which has mentioned that we will not give dividends, but whenever the time is right, we will give you bonus units. So it is similar to dividend reinvestment, kind of, but a regular plan gives you 2 options. Like, do you want to get cash dividend or do you want dividend reinvestment? A bonus plan does not give you that option. A bonus plan says we will give you bonus units only. If you are happy, buy the plan, otherwise you don't. A growth, again bonus plans, the return has to be calculated on a total basis. And lastly, there is a growth scheme where there is neither dividend nor bonus. So here you can do the working based on a per unit basis or on a total basis as well. The return is usually in the form of appreciation of the NAV. Okay, there are a few interesting questions that the institute has asked on this section, where they have asked in certain questions, they have not told you whether it is dividend reinvestment plan or not. However, the number of units increase. You purchase 10,000 units, you are selling 11,296 units. There is no further purchase. So you interpret that it is a dividend reinvestment. Or in certain questions, they have also incorporated the effect of taxes or STT, securities transaction tax, where you would say that, okay, at the end, I'm getting a total proceeds of, let's say, 100 units or 1200 units into, let's say, 50. However, I'll have to pay some STT, I'll have to pay some short-term capital gains, and whatever is remaining post-tax, post-expenses will help me in calculation of my return. In all cases, unless given otherwise, we try to find the annualized return, that is 12 into 12 by months, you will do the working. There are certain fund management strategies. There are 3 strategies. One is the buy and hold strategy, whereby you will just buy the shares and you will hold them. You will not do any rebalancing. Then there is a constant ratio strategy, where let us say you have a dedicated ratio like a debt to equity ratio of 50:50, in which case you will keep on continuously rebalancing at specified time periods, let's say every month. If the balance changes dramatically, you will keep on, or beyond a threshold, you will keep on rebalancing. This is called as a constant ratio strategy. And then there is a constant proportion portfolio insurance strategy, where you kind of determine whatever is your floor value, and you don't want your portfolio to fall below the full floor value. So if your portfolio is 3 lakh rupees and your floor value is 2,50,000, then 50,000 is a cushion that you have, which you can invest in equity. If you are more risky person, you can have a multiplier, which is given in the question, let's say of 2 times. Then you can invest double of your cushion, that is 1 lakh into equity and remaining 2 lakhs in debt. And again, you can keep on rebalancing this at specified dates. So there are various steps which can be done. Institute has asked at best one question on each of them, so it's not as extensively tested, but if it comes, you should be aware. Next, there are a couple of other things before we go to the next chapter, which I want to discuss over here. One is about load. There's entry load and then there is exit load. Entry load is the additional cost that an investor has to pay when he wants to enter into the fund. Exit load is the cost that will be deducted before he gets the proceeds at the time of redemption. Is it there in every fund? No. If it is specifically mentioned, you will add the entry load at the time of purchase to find your total cash outflow, and you will reduce the exit load at the time of sale to find your total net sale proceeds in hand. There is also a question on dividend equalization, which can potentially come. Dividend equalization again will be done only if the question specifically asks you. This is in case there are new units which are issued or units that are redeemed. You will try to find the equalization charge, that is the income earned during that period divided by the old units. This is the income which is attributable to the old unit holders. The new unit holders will also have to bring in over and above the NAV this amount in order to ensure a dividend equalization. At the end, when dividend is distributed, the amount available for distribution will be the total profits during the period plus the dividend equalization amount received minus dividend equalization, if any, which is paid. So this kind of takes care of mutual funds. There's also performance evaluation like Sharpe ratio, Turner ratio, Jensen's alpha based questions, which can come in the mutual fund section as well. And now we go to the mother of all topics for your SFM, which is on foreign exchange. So before we proceed into the actual mechanics for foreign exchange, there is the terminology on foreign exchange that you should be acquainted with. So you start with the codes. There can be 2 codes, which is direct or indirect. Direct code is the number of units of your home currency, that is, let's say rupees, for every unit of the foreign currency, let us say dollars. On the other hand, indirect code refers to every unit of the foreign currency, let's say dollars, for every unit of the home currency, which is rupees. It's a lot more popular to use direct quotes, but nevertheless you see some questions which are based on indirect quotes as well. Now, foreign exchange market is typically an over-the-counter market where you buy and sell foreign currency across the counter, not through exchanges. You can do that through exchanges as well, but predominantly over the counter with foreign exchange dealers and banks. And hence the foreign exchange dealer does not really know whether you are here to buy or sell the currency, and hence the foreign exchange dealer gives you both the rates. One is a bid rate and one is the ask rate. B for bid, B for buy. Bid rate is a rate at which the dealer or the banker buys the foreign currency from you, or currency which is given the base of the exchange rate quote from you. So if it's a rupee per dollar quote, it is the rate at which the dealer is prepared to buy the dollars. If it's a dollar per rupee quote, it is the rate at which the dealer is prepared to buy rupees. It is the rate at which the dealer is prepared to buy the currency which is there in the base, the bid rate. The ask rate is the rate at which the dealer is prepared to sell the base currency. That is, if the dealer is selling, the customer is buying. Remember, the bid rate is the banker's buying rate. That is a customer's selling rate. The ask rate is the banker's selling rate. That is a customer's buying rate. Typically, the banker makes a profit from the difference in the bid and ask. So if the bid rate, for example, is 80 for the dollar, the ask rate may be, let us say, 82. And hence, the 2 in the middle is the bid ask spread, or also called as the profit for the banker. Now, when you look at exchange rates, we go into exchange rate determination theories on how exchange rate is actually determined. If, let us say, against every dollar, the rupee is 83, how is it 83? Is exchange rate theory. So, exchange rate determination as per economic theory should be based on purchasing power parity. So, a basket of goods, let us say bats or pens, should be costing the same in India or same in the US if you convert it. So over here, if not, there's a possibility of arbitrage. So this is called as a absolute purchasing power parity theory. That is, a basket of goods will cost the same across the world. So if, let us say, a basket of 50 pens is costing $1 in the US and the basket of 50 pens is costing 50 rupees hypothetically in India, that means if A is equal to B, B is equal to C, that is $1 is equal to 50 pens, well 50 pens is equal to 50 rupees, then $1 equals 50 rupees. This is how the exchange rates would have been determined. Now, why would the exchange rates change? Simple economics theory tells you that, well, if the exchange rates are determined based on the purchasing power, their rates should change as the purchasing power changes. That is, purchasing power changes due to inflation. So, how much can $1 now buy? How much can 50 rupees now buy? So, if there's 10% inflation in India, those same 50 pence would cost 55 rupees. But if there's 0% inflation in the US, those same 50 pence will still cost $1, in which case the exchange rate has to be modified and it has to go to 55 rupees per dollar. This is the base for what you call as a relative purchasing power parity theory, or also called as inflation rate parity theory, where you use this formula F by S. F is the rate expected to prevail in the future, also called as the forward rate, upon S, which is the spot rate, equals 1 plus the inflation rate in a country upon the inflation rate in the other country. Now, a student always is kind of confused at which rate is to be taken in the numerator or denominator. It depends on the rate quote. So, if your rate is rupees per dollar, then rupees rate will go in the numerator, dollar in the denominator. If the rate is, let us say, pound per Canadian dollar, then the pound rate will go in the numerator, Canadian dollar, Canada's rate will go in the denominator. So it depends on the rate that you are using. Okay, the logic that applies for inflation also goes for interest rate. There's a separate derivation of covered interest arbitrage or interest rate parity theory, but loosely speaking, countries which have a higher inflation also have a higher interest rate, countries which have a lower inflation also have a lower interest rate. So in certain questions, instead of inflation rate, interest rate may also be given and the same formula can work. This is called as inflation rate parity or interest rate parity theory, and which helps you in predicting the theoretical forward rate which should be prevailing. If you want to find the rate after 1 year, this is a formula, but if you want to find the rate beyond 1 year, after 2 years, 3 years, 4 years, typically we assume annual compounding, and hence you can raise it by n. So if you want to find it after 3 years, you can take this rate raised to 3. However, if you want to find it after 3 months, we don't do monthly compounding, and hence whatever is your rate, for example 12% per annum is inflation in India, then 12% per annum equals 12% to 3 by 12, that is 3% for 3 months. So you will take 1 plus the inflation rate in India into 3 by 12 upon 1 plus the inflation rate in the US into, let us say, 3 by 12. Some questions might also ask you to calculate the forward premium or discount. Forward premium or discount is calculated as F minus S upon S. F is a forward rate minus a spot rate upon the spot rate. Like it's like P1 minus P0 upon P0 into 100. However, this will be based on the period for which the forward is there. So if the forward is 6 months, then the forward price is after 6 months. You want to find the premium as percentage per annum, then you do F minus S upon S into 100 and then again into 12 by M, where M is the number of months. So if it is 12 by 6, 6 months are there, then you will find the rate of return after 6 months. This is a formula that you use for the item which is there in the base. So if it's a rupee per dollar quote, then for dollar, finding the premium or discount will be based on the formula that we discussed. Like in your foundation 11th, 12th, you might have heard that, well, if your GP margin is 1/5 on selling price, that means it is 1/4 on cost. In a similar way, here, if you want to find the premium or discount on the other currency, rupee per dollar quote, you want to find a premium or discount on the rupees, not on the dollar, then you will rearrange the rate a little. As a shortcut, you can do S minus F upon F into 100, all else remaining constant. All that you are doing is you are changing the base. In one case, the base is the forward. In other case, the base is spot. Premium is typically positive, discount is typically negative. Acha, there are certain rules that you need to remember. Currency strengthening or weakening. Typically, countries with a higher interest rate or higher inflation rate will have a weaker currency as compared to countries which are having a lower interest rate or lower inflation rate will typically have a stronger currency. A lot of questions may ask you to interpret whether the currency rates are expected to be stronger or weaker. You can use this rule and figure out whether going forward a currency is going to strengthen or weaken. Strengthening means for every 1 unit of that currency you will get more. So for example, the dollar moved from 70 rupees per dollar to now 82 per dollar. That means for every $1 you are getting more. So dollar has strengthened. At the same time, rupee has weakened. Okay. So over here, foreign exchange arbitrage. So over here, arbitrage refers to riskless profit. The most simplest form of arbitrage is the 2-point or 3-point arbitrage, where you can actually buy dollars in one of the market, let's say in India, and use those same dollars and sell it in the US if the prices are different. So for example, the rate is 50 per dollar in India, and that's in the US the rate is 51. I can buy the dollars in India and sell it in the US and generate a 1 rupee profit. This can be done in multiple markets as well, in which case if there are 3 markets used, it's a 3-point arbitrage, 4 markets used and 4-point arbitrage and so on. A very important concept for you to know would be the covered interest arbitrage, where you try to exploit the differences between the spot and the forward price. So if let us say your spot rate is 50, the interest rate in India is let us say 12%, interest rate in the US is 6%, but the forward rate is for example 60 rupees, in which case if the theoretical forward rate is, let us say, I mean I don't have the numbers handy, but hypothetically if the theoretical forward rate comes to around 52 or 53, then one can say that actually these dollars are worth 60 after 1 year. Theoretically they should be worth only 52 or 53, in which case I can exploit arbitrage. I can say that if I'm getting a chance to sell at a higher price, I will sell in the forward market. So I will sell in the forward, then I will buy in the spot market, borrow and have a covered interest arbitrage position. So in the example that we have discussed, we will sell in the forward market, and if you're selling in the forward, you will buy in the spot. Well, if you're buying dollars in the spot market, you must have borrowed rupees. So you will borrow rupees, use those rupees to buy dollars in the spot market, invest those dollars in the US, and then after 1 year, you will sell those dollars at the 60 rupee rate and come back to rupees only. So this is about covered interest arbitrage. Compare the theoretical rate, for example in our case 52, with the actual forward rate in our example as 60, in order to exploit arbitrage possibilities. Hedging, well, you can use various products like forwards, you can use futures, you can use money market, you can use options. There is swaps, but they're not technically hedging products. They're helping you in reducing the cost, or maybe fate of forwards if you have to cancel or take early delivery, etc. So when we are looking at forward hedging, if I'm an importer or if I'm a borrower, then in order to hedge, I will need to pay. If I have to pay dollars, I need to buy the dollars, and hence if a direct quote is given, I will buy the dollars. If I'm an exporter, I'm going to sell the dollars, in which case I will take a forward in order to sell the dollars. If indirect quote is given, there are 2 ways in which you can think. One is you can convert them into direct quote and then solve. Alternatively, you can say that indirect quote is a dollar per rupee quote. So if I'm an importer, I need to buy the dollars, but the base currency in a dollar per rupee quote is actually the rupees. If I am buying the dollars, the banker is selling the dollars. Fair, but if I'm buying the dollars, at the same time I am, as an importer, giving or paying or selling the rupees. If I am selling the rupees, the banker is buying the rupees, and accordingly I can mold my thought process to figure out whether the right rate is taken or not. Now this is where things get a little nasty, where you need to have a little bit of practice. It is very difficult to just explain that in concept terms, but this is where you have to be very careful whether you select the right rate or not. Like, you might also have questions which might involve cross rates. Cross rates means you don't have a direct quote, like you want let us say the Swiss franc, but you don't have a direct quote. So there will be a rupee per euro and then euro per Swiss franc. So you will ensure that you arrange the rates in such a way that euro and euro gets cancelled and your answer is rupees per Swiss francs, in which case you have to be careful that we select the correct bid or correct ask. That depends on what is there in the base. Okay. In certain questions, there can also be exchange margin, where a banker might be charging margin. Whenever the exchange margin is given based on a buying or selling rate, typically a banker will charge margin based on the banker's buying or selling rate. Typically, if you are an exporter, the margin will be added, it will increase your cost. If you are an importer, margin will be added, it will increase your cost. If you are an exporter, margin will be deducted, it will reduce your net proceeds. You need to be careful in this margin, and even while you are selecting bid and ask, you have to see who is buying, who is selling. But at the end of the day, a general rule is, as a customer, if you have to pay, you will end up paying more. The rate that results in you paying more is the rate to be selected. If you are going to receive, then you are going to receive less. The rate which gives you lesser inflow is the rate to be selected. Okay. Then there is certain questions where there can be swap points. So the rates may be given in points. So your spot rate might be given, for example, as 50.1234 and 51.3456, for example. And then the 1 month forward rate may be given, just a second, the 1 month forward rate may be given as, let's say, 30 and 40. This is called as points. Now, there are, or 30 and 45, there are certain rules that you have to remember, and we have discussed the concept behind this as well, but nevertheless at this point we'll just focus on the rules that you have to remember in order to find the forward rate. So if these points are given in ascending order, you add A for ascending, A for add. If the points were given in descending order, like 45 and 30, then you will subtract, deduct, D for descending, D for deduct. These points are to be added, the bid points to the bid rate, ask points to the ask rate, and they will be added from the right hand side. So for example, this is 50.1234, there are 4 points, which means you will say plus 0.0030, ascending it to add, and 51.3456, there are 4 decimals, so this is 0.0045. So bid points to the bid, ask points to the ask, depending on the number of decimals from the right hand side. So this is something that you have to be careful about. Okay. Next, you have another hedging technique, which is the money market. In case of money market, what do we have to do? Well, money market does not look at the forward rate which the bank gives you. In fact, it looks at money markets where you can enter into short-term deposits or short-term borrowings to get your desired exposure. So over here, if let us say you are an importer, ideally you have to pay the dollars. If you have to pay the dollars, that means you have a liability in the foreign currency, and hence in order to protect, you need to create an asset in the foreign currency. So ideally, I will try to enter into actions in such a way that I will invest in the foreign currency, but I don't have anything to invest. So probably I will try to borrow in the local currency, convert that money at today's spot rate, invest it in the foreign currency in such a way that the amount at the final date will be exactly what you need to pay. So what will be your total cash outflow? The amount of borrowing in the local currency plus the rate of interest will be your cash outflow, let's say after 1 year. On the other hand, if I am an exporter, I have an asset in the foreign currency. So if I want to protect myself, I will have to create a liability in the foreign currency. So I will borrow in the foreign currency in such a way that after, let's say, 1 year, whenever I'm going to receive the money, the amount is exactly equal to what I'm going to receive. So I will receive the money and repay that borrowing in the foreign currency. But the amount that I've borrowed in the foreign currency, I'll convert it into the local currency at today's spot rate and then deposit it. So basically, as an importer, I will borrow in the local currency. I've explained the rationale for that. And as an exporter, I will borrow in the foreign currency. The logic primarily is because I have a liability in the foreign currency for an importer. So in order to hedge, I will invest in the foreign currency, asset in the foreign currency. If I'm an exporter, I have an asset in the foreign currency, a receivable. In order to hedge, I will create a liability in the foreign currency. Okay, so this is about money markets. Next, you have futures. Now, this is something which is fairly complicated. Now, between forwards and futures, they are similar, just that forwards are over the counter, futures are exchange traded. Forwards can be customized, futures are standardized. And as a result, futures will have a lot size, a contract size, as well as an expiry date, whereas forwards don't have a lot size or an expiry date. You can customize it to the dates and size that you want. So how do you solve a futures question? Well, we typically have around 4 steps around this. So first, you will try to determine the strategy. So for example, if you are an importer, you want to buy the dollars, and if the futures are also quoted in the dollars, your strategy should be to buy futures. Second, there can be various maturity dates, like sitting today you are on 1st January and the payment has to be made on 31st March. You might have a February futures, you might have an April futures, and then you might have a July futures. We will say that the futures should be selected in such a way that it covers your maturity. Ideally, we would have loved the March futures, but if it is not there, then it should be selected in such a way that it covers your maturity, that is March. So February is out of the way, and it is closest to your maturity. So there can be an April futures and July futures, but July futures is going to be affected by uncertainties even in the month of May, June, etc. And hence we will avoid that. If you are having the April futures, then you will select the April futures. Third is the number of contracts. The number of contracts is the invoice value divided by the contract size. This will probably come in decimals, and you will round it off to the nearest number. So this is where you have your futures. So you will buy, let us say 10 April futures at a particular price. Now futures are exchange traded, and hence they will typically be net settled. So if you want to find your cash flow, actual cash flow, then on the settlement date you will go to the spot market, because from the exchange you are not going to get dollars. You will go to the spot market and you will buy those dollars. Once you buy those dollars from, let us say, the spot market, you will use those dollars in order to pay your supplier. So you will have a cash outflow in rupees. But then you don't need the futures contract anymore. So you have originally bought the futures, now you will cancel it by selling the futures. And hence you will find a gain or loss. That is the selling price minus the cost price into the number of contracts into the contract size. This will give you the gain or loss. Typically, should you add, should you subtract, we keep it automated in the way that we will say that if it is a cash outflow, if you are an importer, cash outflow will be negative, cash inflow will be positive. If there is a gain, automatically selling price minus cost price will come to be positive. If there's a loss, then selling price minus cost price will come to be negative, and your answers will be automatically derived. Now, a thing that you have to remember in these workings is you need to see whether the invoice currency and the futures contract currency is the same. If it is the same, then the working is fairly easy, as we have just discussed. But if it is not, then you will have to kind of, while determining the number of contracts or while determining the strategy, you will have to convert, because invoice may be in dollars and the contract may be in rupees. So you will have to convert, let us say, the invoice into the equivalent rupees at the futures rate. Strategy will be based on rupees, and when you do the settlement as well, selling price minus cost price will be dollar per rupees selling price minus dollar per rupees cost price. So your gain or loss will come in dollars. You will have to again convert that back into rupees. You need to be a little careful in that particular set of calculations. In certain futures questions, you might also get a futures margin. A futures margin is a deposit that has to be paid, and the deposit is not a cost, because the deposit will be refunded back. If there's no gain, no loss. If there's a gain, along with the deposit, you will also get the gain. If there's a loss, the loss will be adjusted from the deposit. But that margin is not a cost. Then what is the cost? The interest that you will forego because you kept the money in the margin will be a cost. So forwards don't carry a margin, but futures can sometimes carry a margin. Now, there can be questions involving foreign exchange options. There can be call option or put option. Call option is the right to buy. Which currency? Well, currency in the base. So if it's a rupee per dollar quote, call option is the right to buy the dollars. Put option is the right to sell. Well, which currency? The currency again in the base. So if it's a rupee per dollar quote, it is a currency in the denominator, which is, let us say, the dollars. So who prefers a call option? Typically the importer prefers a call option. Who prefers a put option? Well, the exporter prefers a put option. Again, you need to see what is there in the base and formulate your strategy depending on what is there in the base as well. While you are doing currency options, you have to be careful to kind of do around 3 adjustments. First, again you'll have to find the number of contracts, because currency options are also exchange traded, and hence you'll have to determine the number of contracts that have to be entered. And there may be some unhedged portion, so that unhedged portion will have to be separately hedged by using forward or other instruments. And secondly, there will be a premium in case of options, which is not there in forwards, which is not there in case of futures. And this premium is a cost. It's not like a margin which is refundable. It is a cost, and which is upfront and non-refundable. And hence on the premium as well, you might need to do time value adjustment. So this is something that you have to be careful while you are evaluating currency options. Next, you go to currency swaps. Now, swaps are exchanges. Typically, they are not hedging methods, but typically they are methods which are done in order to reduce the transaction cost. Like for example, Mahindra may be a borrower in India, and there may be a company in US like Chrysler in the US. Now, Mahindra is very well known in India, not in the US. Chrysler is not as well known in India. And hence, if Mahindra wants a dollar loan, it goes to a US bank to borrow. It might get loan at an expensive rate. Chrysler comes to India and wants to take a rupee loan for its Indian project. It might get it at a costly terms. So what they can do is, Mahindra can borrow in rupees in India, Chrysler can borrow in dollars in the US, and then they can exchange the rupees and dollars and agree to pay each other or reimburse each other for the same. So your net cost of financing will have to be calculated. Your net cost of financing will be the cost that Mahindra pays to its Indian bank plus the cost that it pays to Chrysler under the swap minus the amount it recovers from Chrysler under the swap. This is a net cost that Mahindra is going to pay, and for the swap to be beneficial, this should be lower than the cost that Mahindra would have paid had it gone to the US and directly borrowed. So let us say after doing all of this, Mahindra net pays 9% on its dollar amount. If it directly borrowed, it paid 11%, in which case we said that okay, this swap is beneficial. Okay, so this is about currency swaps where you have the effective cost as well. Next is one of the most difficult sections when it comes to foreign exchange chapter, which is called as fate of forwards. So when we are looking at fate of forwards, there are 3 to 4 main things. One is cancellation, one is extension, one is early delivery, and then a case of late cancellation. So first is cancellation. Why do you need to study this for forwards, not for futures? Because futures are exchange traded. If you don't want a future, you just call up a broker and sell it. So if you have bought it, you sell it. But in case of forward, it is one-to-one. So you can't just call up the bank and say, I don't want it, because it's a one-to-one contract. And hence, if you want to cancel it, you'll have to take the opposite position. So if you are if on 1st of January, you are an importer who has bought forward $1,000 on 31st March, and let's say come 20th February, you believe that the import is not happening. You don't want the dollars, but the contract is already entered with the bank. So the bank, if it is not ready to cancel it, you will have to enter into a position which effectively cancels your exposure, in which case on 20th of February, you will enter into a reverse forward. That is a reverse action. You have agreed to buy the dollars as a customer. Now you will agree to sell the dollars. 1 month forward for the balance unexpired period. So after 1 month, technically what will happen is, on the original forward, you will buy the dollars, and on the reverse forward you have entered, you will sell those dollars. So you are no longer exposed after 20th of February. You have cancelled your exposure. So you will enter into a reverse forward for the balance unexpired period. Sometimes what might happen is, you might come on the date of maturity and say that I'm unable to take the delivery or unable to pay, in which case there is no balance unexpired period, and hence the cancellation will again happen at the opposite action. So if you are an importer, you had agreed to buy the dollars, now you will have to sell those dollars. But at which rate? Well, at the spot rate, because you are at the maturity date. If it is before the maturity, then you will again enter into a sell transaction for the balance unexpired period, that is the reverse forward. If you want extension again can also be on the due date, or it can be before the due date in the same way, but extension comes with a hidden cancellation. So if you want to extend, that means you will cancel the existing contract and then enter into a new forward contract. So if on 20th February you now want a contract which expires in, let's say, April, then it is as if on 20th February you cancel the existing contract and then enter into a new forward contract for a 2-month period, that is March and April. So extension always involves a hidden cancellation. These two, in my opinion, are quite manageable. The problematic cases are involving early delivery as well as late cancellation. So the the treatment over here is based on the FEDI rules, the Foreign Exchange Dealers Association of India, and FEDI has given a specific set of rules, and hence we have to do the working based on those set of rules only. So first we study early delivery. In case of early delivery, what happens is, let us say on 1st January we had agreed to buy dollars on 31st March after 3 months, but now 1 month later, let us say in January or 2 months later in February, we want to buy the dollars and pay the supplier off immediately for some reason. Now if you go to the bank now, the bank is under no obligation to pay that. However, if the bank wants to pay, what all actions will have to be taken? If the bank wants to honor your contract, that on 20th February it will give you the dollars and you will give the bank rupees at the agreed forward rate. So you will have to determine the amount at the agreed forward rate. First cash flow. This is your actual movement of cash. Bank is, you have to do evaluation from banker's perspective because FEDI has given the rules based on banker's perspective. You find the amount that you have to pay in dollars into the agreed forward rate. So this is based on the agreed forward rate. This is point 1. Just keep that in mind. Now second point is, if I have to pay these dollars, if I have to give these dollars, from where will I get the dollars? Because I might have done asset liability management assuming that I will need dollars on 31st March. Now I have to give dollars to my client. So I'm the bank. I have to give dollars to my client on 20th February. So I'll have to go to the spot market and buy those dollars. So over here, second, amount at the spot rate on early delivery. That is the second. This is also an actual cash movement. And third, you must have originally agreed to buy the dollars on 31st March so that you can give those dollars to your client. But now you have already given those dollars on 20th of February and hence the original contract is now not required, and hence you will have to reverse that position. Like originally to the importer, you had to sell the dollars as a banker, which means you must have entered into an offsetting contract to buy the dollars on 31st March from somewhere so that you can give it. Now that contract with the client has already been settled. However, your contract in the interbank market is still open, and hence you will have to enter into a position to close that contract. So you will have to have an amount for offsetting forward. So it is like a cancellation on which on 20th February there is no cash flow. So there are three things. First, you try to find the amount at the agreed forward rate on 20th February. Second, you try to find the amount at the spot rate again on 20th February. And third, you try to find the amount on the offsetting forward which was taken for your original contract. Now, as per FEDI, you will have to take two things. First is you will have to determine the swap loss. Swap loss is the difference between 2 and 3. Why is it swap? Because what will happen is, if you are agreeing, let's say we have taken the case over here, this is the exporter case. I think this case below is the importer case. If I am the bank, I have agreed to give the dollars. I must have purchased the dollars, buy the dollars. So this is buy, but at the same time, if I am an importer, if the client was an importer, I must have entered into a contract to buy dollars on 31st March. Now that contract is not needed, in which case I'll have to cancel it by selling, and hence there will be a spot buy and there will be a forward sell. That's why there will always be opposite actions. For exporter, it will be opposite. So over here for exporter, the exporter is giving you early delivery of dollars. If exporter is giving you early delivery of dollars, you have to give rupees, but those dollars you will sell it in the spot market. So there will be sell in the spot, and then the exporter must have originally entered, the bank must have originally entered into a contract to sell these dollars that it was going to receive. Now you don't need it, so you will cancel it by entering into a buy transaction. And hence there will be a forward buy for the balance unexpired period. So basically, long story short, there will always be opposite actions. So if you determine that in the spot market, like in importer, you have to buy the dollars, then in the forward market you have to sell. Or in exporter, like in the spot market, you have to sell those dollars, then in the forward market you will buy. This is called a swap, and this is happening in point 2 and point 3. So the difference between point 2 and 3 is called a swap loss. If there's a loss, the customer has to reimburse the bank for that. If there's a gain, the bank will hand over the gain to the customer. Next, there is interest on outlay or inflow of funds. So point 1 and point 2, देखो point 1 तो आपको पे करना ही था. It is just that you are doing it a month earlier. This is the agreed forward rate. Point 2 is also a cash flow. So you take the difference between point 1 and 2, which both of these are cash flows. The bank, if it was even unhedged, then point 1 and point 2 would have happened just like it would have happened on 31st March. Now it is happening on 20th February. And as a result, the net difference between 1 and 2 into the interest rate for 1 month will be the interest on outlay, or sometimes interest on inflow if the bank is getting a net cash inflow. The total of both of these will be the charges that are either recoverable from the customer or payable to the customer, swap cost as well as the interest. Okay, the summary over here, there will be swap gain or loss. For an exporter, remember, is going to give dollars to the bank, so bank will have to sell it in the spot market. So spot sell will always have the opposite action in the forward, so forward buy. Just remember that if you are not very clear. If there is an importer is going to need the dollars, so the bank will have to buy dollars from the spot market, and hence forward may it is the opposite position. Acha, interest, well, if there is a cash inflow which is greater than cash outflow, then it's an interest income, whereas if it is cash outflow which is greater, there's an interest cost which I will try to recover. Okay, next there is late cancellation. This is another headache. There's rule 6 as per FedI, which has been recently amended, where they have said that, like in bills of exchange, you have a grace period of 3 days, where bills have a grace period of 3 days. Over here, if you do a no-show, ideally the contract had to mature on 31st March, you had to either come and take the delivery, or you have to tell the bank that I'm cancelling it. But बैंक आपको कॉल करते गया आपने कोई जवाब ही नहीं दिया, you did a no show, in which case FedI gets really angry and it is going to recover a lot of charges from you. And this is the only case among all the cases where if there is a gain on such cancellation, the gain will not be passed on to the customer, but if there is a loss, the loss will be recovered from the customer. This is a penal clause because you did a no-show. This is in order to dissuade customers from doing no-show. If they don't want to take the delivery, you call up the bank and say that, okay, I'm cancelling, but you do not do a no-show, otherwise you'll have a huge consequence. So there are 3 aspects over here. Like the swap cost and interest still continue as the early delivery case. However, an additional exchange difference is also charged. The exchange difference over here is a difference between the agreed forward rate and the offsetting spot rate on the date of actual cancellation. So the contract will remain active for 3 days max. So 1st April, 2nd April, 3rd April, and then on 3rd April it will automatically get cancelled. So you are going to take the difference between the agreed forward rate and the offsetting spot rate on the date of actual cancellation. Actual cancellation can be 3rd of April, or if the customer comes on 1st or 2nd, then on 1st or 2nd April. So whatever is the difference is called as the exchange difference. Over here, exchange margin, if any, will be adjusted if it is given in the question. Apart from that, there will be a swap cost adjustment like the early delivery case, like the banker might have entered into an arrangement. So let us say there was an importer who had agreed to buy dollars from the bank. The banker must have arranged those dollars. So in order to sell the dollars to the importer, the banker must have entered into a contract to buy from the interbank market. Now the customer did not appear on 31st March, but the banker would have had to buy the forward rate agreed. So this is the offsetting forward rate. The banker would have had to execute that. However, so just a second, this is the original forward rate for the offsetting interbank market. So that's an actual movement of cash I'll have to pay. But what will the bank do? The bank has nothing because the client is not appearing. So jo bhi dollar aaya, bank will have to sell it. So over here, this is a spot rate on date of original maturity on 31st March. The rate on 31st March, if I were to buy those dollars, which I've already agreed from the interbank market, but these dollars, the client is not coming, so I'll have to sell those dollars in the spot market, and hence on this I will recover the difference ka interest. Apart from that, there will also be a swap cost where I will have to take additional actions because the customer did not turn up. What are the additional actions? First, I will have to sell those dollars that I now have in the spot market, so spot rate on the date of original maturity. And in order to protect myself that if the customer is coming in the future, then a forward will have to be taken to pay the importer, client, because I don't have any forward right now. So a forward rate for the earliest maturity. So these are the things that you'll have to consider. Again, this is not something which if you're listening it for the first time, आपको समझ में आएगा. If you've already done this earlier, this can kind of help you in just touching upon the concepts. But ये best early delivery as well as late cancellation is best understood through sums and numbers. So I would strongly recommend you refer that along with this discussion. So that takes care of fate of forward. And next we go to the last few ancillary concepts, sundry concepts like netting and matching. Like if I'm an importer and exporter both, I may have an import payable in dollars and I have an export receivable in dollars. I can take protection only for the net amount. Or I may be a multinational company who has cash balances across various geographies. I can decide to invest the cash balances at the different respective geographies or net them off if there's borrowing in one and deposit in another, and only the net amount is invested. Or I may be a multinational corporation who has trading in different currencies. I might have to find out the net balances that I pay rather than making full payments in each currency. So this is about netting and matching. There can be exporter-importer case, intergroup cash or transaction management also can be covered here. Fairly simple concepts. Now there's also a theory and a practical concept over here in terms of the types of exposure. There are three types of exposures. There can be transaction exposure, translation exposure, and a complex operating exposure. Transaction exposure is nothing but the gain or loss if the transaction remains unhedged. Almost everything that you try to hedge in the earlier section is a transaction exposure. That is, if the transaction remains unhedged, how much additional cost can be incurred. Translation exposure is nothing but exposure which is arising out of a foreign currency translation, like Tata has Jaguar and Land Rover, and now JLR is converting its financials into rupees for the purpose of foreign currency consolidation, and hence an FCTR, foreign currency translation reserve, arises. Now this is a gain or loss which is on the books on paper, because JLR is not remitting all of its money back to India right now, and hence it's a translation exposure. Most companies don't hedge translation exposure unless they have an imminent plan to sell the entire operation, in which case they might hedge the foreign operations translation exposure. And lastly, you have something called as operating exposure. In case of operating exposure, you look at the exposure which is there due to the entity which is operating in the foreign environment. So this is the foreign exchange gain or loss if the transaction remains unhedged. That is a transaction exposure, plus a gain or loss due to changes in demand. Like you might price your goods in rupees, but if you are selling it to the European customers and the euro rate changes, if the euro rate earlier hypothetical was 50 rupees per euro and you were pricing your products at 5,000, then 5,000 divided by 50, the products would cost 100 euros for a European customer. But now if the euro changes from 50 to, let us say, 80 hypothetically, in which case if you are pricing the products same at 5,000, 5,000 divided by 80, the products now are only 62.5. And hence the price in euros is falling, and hence the demand can increase because you are operating in the foreign environment. If you are selling it to Indian customers only, पहले भी 5,000 था, अभी भी 5,000 है, there would be no change in demand. But because you are operating in the foreign environment, even if you have priced your products in rupees, there can be a foreign currency exposure which is called as operating exposure, which is gain or loss due to changes in demand, where you will have to find a change in price, multiply that change in price with elasticity to find how much is the change in quantity demanded, and the change in quantity demanded into the profit per unit will give you the gain or loss due to changes in demand in case of operating exposure. There can also be questions involving foreign currency accounts. There are three foreign currency accounts. There is Nostro account, Vostro account, and Loro account. Nostro is our account with you, Vostro is your account with us, and Loro is your account with a third party. So over here, the questions that might come is you might be asked to calculate the cash balance or the exchange position balance in case of, let us say, a Vostro or a Nostro account, in which case in cash position you will look at only the cash transactions like actual remittance, actual deposit, whereas exchange position can get affected due to forward purchase, forward sale, forward purchase cancelled, forward sale cancelled, or bills purchased, bills cancelled, drafts issued, drafts cancelled. All of this will affect the exchange position as well. A few other concepts on this chapter may also be pertaining to something like GDR, or Global Depository Receipt, which is basically a basket of underlying shares, and the cost of GDR is very similar to the cost of equity shares. you have to sometimes find the issue price of GDR or the number of GDRs to be issued, and then you might have to calculate the cost of GDR, which is very similar to the cost of equity. You can use Gordon's formula or CAPM for the same. So this largely takes care of foreign exchange. I hope you have some perspective. Next, going from one heavy chapter to another heavy chapter, we go to derivatives. So in this chapter, we focus on equity section and to some extent commodities as well. As we have discussed earlier, there are 4 types of derivative products. There is the forwards, which is one-to-one over the counter. There is futures, which are typically exchange traded. There are options, which can be call or put, which is favorable for the holder. The writer earns a premium on these. And then there is swaps, which are typically for the purpose of reducing your transaction cost. We first start with the derivative futures or forwards. The valuation over here is done by something called as a cost of carry model, where we are trying to find the value of a share in the future. You can use the arbitrage principles and find the value in the future. So for example, if the share today is worth 100 and the market rate of interest is, let us say, 10%, the future price is calculated as 100, or let's say 12%, 100 plus 100 into 12% into, let's say, 12 by 12 or 6 by 12 as the case may be. So over here 100 plus 12 equals to 112 is considered to be the theoretical futures price under what you call as cost of carry model, where 12 rupees is the cost of carry. Now this cost of carry can be depending on the time frame. So for example, if the time frame over here is 6 months, then you will do 100 into 12% into 6 by 12, in which case this will be 6, and hence the theoretical futures price has to be 106. Sir, what if it is not 106? Well, it can be, it will give rise to an arbitrage opportunity. So for example, if this was a 12-month time frame and if the price is not 112, let us say the futures price for example is let us say 115, in which case what you can do is you can exploit arbitrage. So you can say that if I don't have money, I can borrow 100 rupees today at 12% interest, pay 112 after 1 year. But how will I get this 112? Well, enter into a forward sale today at 115, and hence I will sell at 115, get 3 rupees arbitrage profit. This will result in huge selling pressure on the futures. A lot of people would love to sell in the futures market, and as a result, that huge selling pressure, demand supply tells you that if there are more of supply, then the price will come down. The opposite will happen in case of the price is 106 or 103. So this is spot plus the cost of carry for a non-dividend paying stock. But if it is a dividend paying stock, remember the spot holder. So this will be the futures price. So we are saying that in the future price should be 112. But if during these 12 months, if dividend is going to be received, let us say dividend worth 5 rupees is going to be received, that is going to be received by the spot holder, not the futures holder. So the future holder will say that the price today of 100 considers all the future dividends. However, dividend of 5 rupees are going to be received by the spot holder, not by me. And as a result, I will take the X dividend. So if it's a dividend paying stock, I will take the spot price, I will add the cost of carry, but I will subtract the value of dividend. So it's not necessarily the present value of dividend, it depends on when the dividend is actually paid. So if dividend is paid at the end of the year, you will subtract the dividend. If the dividend is paid at the start of the year, you will do the time value adjustment. Everything has to be at the same point of time, either starting or at the end. Here you are taking everything at the end. So 100 today becomes 112 after 1 year. So if dividend is paid of 5 rupees at the end of 1 year, we will not do any adjustment. But if 5 is paid at the beginning of the year, we will do a time value adjustment on this. This is in case of usual questions where there is annual compounding. However, there can be questions which involve even continuous compounding. So in case of continuous compounding, what will happen is you will take e raised to Rn. So your theoretical futures price will be spot into e raised to Rn. If there is dividend as well, then spot into e raised to R minus D into N, where N is the number of years. This is in case of regular stock futures. In case of commodity futures as well, you will still have the cost of carry. However, in commodity futures, you will also have to look for storage costs because it is costly sometimes to store commodities, and hence a spot holder will have to, like in the earlier case, spot holder was getting dividend, so we subtracted it. Now the futures holder does not have to incur storage cost, but the spot holder has to incur it, and hence we will add the storage cost if any, and subtract the convenience yield value, if any. Again, if you are adding the present value of these costs, you will also have to adjust the cost of carry on these items. Cost of carry refers to the interest. So over here, there are various formulas. You can refer the SFM shield if you have. We are just trying to generalize it over here for your easy understanding. Various formulas depending on whether dividend is paid at the beginning, dividend is paid at the middle, dividend is paid at the end, etc. But as a concept, you will have to adjust the interest. You also have to adjust the storage cost. You also have to adjust convenience yield. Storage cost will be added. Convenience yield is a convenience for the spot holder, and hence it will be deducted. Acha, one of the best ways to hedge in case of futures is using what you call as index futures. So you can have the stock futures, and then you can have something called as index futures. So what happens in case of an index future? Well, in case of an index future, if I have the share of Reliance, ideally I should hedge my underlying spot portfolio by going short on the share of Reliance in the stock futures market. Here, instead of taking Reliance, I'll take the Nifty. So my underlying is Reliance, but I'm hedging it using the Nifty. And as a result, my hedging is done using a different product. However, is there a relationship between the price of Reliance and the price of Nifty? Well, yes, beta is a measure of that relationship, and hence you will have to develop your strategy by considering that. So step number 1 for index futures hedging, you will first determine the strategy. So if you are long the portfolio, that is you have purchased a portfolio, you will go short the Nifty. If you are short the portfolio, then you will go long the Nifty, basically the opposite action. Second, maturity, you will take the contract which matures at or after your intended investment horizon. So if you are worried about the uncertainty within 3 months, you will take the contract which is maturing at or beyond 3 months, not before that. Third is the number of contracts which we can calculate as the portfolio into the beta. So that is the beta adjusted value upon the contract size. That will give you the number of Nifty units that you have to take. Again, you have to be careful that the contract size may be the price of the Nifty today, let's say that is 17,000 into, let's say one Nifty has 200 units. So 17,000 into 200, let's say 34 lakhs will be approximately the price of one contract. Okay, if your portfolio is 340 crores, then 34 lakhs upon 340 crores, let's say 1000 contracts is what you need to enter. And lastly, if you want to find a gain or loss, the working remains the same. You take the selling price per Nifty minus the cost price per Nifty into the number of Nifties that you have entered into the contracts that are there. So there may be 200 Nifties in one contract, and you might have entered into 1000 contracts. So that together will give you the gain or loss on settlement. So over here, this is for index futures hedging. Largely index futures and stock futures function in the same way, just that we need to remember that in case of stock futures, if there's dividend, then dividend is a percentage of the face value in case of stock, but in index you don't have a face value, and hence dividend is a percentage of the index price, not face value in case of index futures cases. Secondly, when you look at dividends, for stock they are paid usually on a date, but index comprises of so many securities, and hence dividend is not as on a particular date, but it is a percentage per annum number. So these are the two differences between stock and index futures. Acha, next you have questions which might come on margin. So there are a couple of questions, and usually the initial margin amount should be given, but if it is not given, in one of the questions I have calculated using the average daily volatility plus 3 times into the standard deviation of that. That will give you the initial margin, and then there is a maintenance margin which is calculated as the initial margin into the percentage given. What is to be done? Well, if there's a loss on a particular date, it will be taken out of the initial margin. Now, if your initial margin is 12,000 and your maintenance margin is 10,000 and your loss on a particular day is 2,000, then your initial margin will come down to 10,000. You don't have to bring in anything. However, the next day there is a further loss of 2,000, then your margin becomes 10 minus 2, that is 8,000, and hence you will have to take it back to the initial margin level. It falls below the maintenance margin, and hence you will have to take it back to the initial margin level of, let us say, 12,000 rupees. So there will be a margin call of 4,000 rupees. So questions might involve calculation of the margin call. Next, you can have options. So in options, first of all, there are two types of options. There is the call, there is put. Call is the right to buy, put is the right to sell. Call option will be exercised typically when the price increases. It is a bullish position. So if the price increases, call option typically gets exercised. So if your spotted expiry is greater than the exercise price, then the call option is exercised, and the payoff for the holder is the spotted expiry minus the exercise price. Put option on the other hand is a bearish position. You expect the price to fall as a holder, and hence it will be exercised if the spotted expiry is below the exercise price. So the exercise will happen if the spotted expiry is lower than the exercise price, and the payoff over here will be the exercise price minus the spotted expiry. This will be the payoff. Questions might involve calculation of the net payoff, which is calculated as the total payoff minus the premium. No time value adjustment is done in case of these payoff calculations or net payoff calculations, in line with the institute and generally accepted solutions. Acha, then you look at option strategies. This is not really important from an exam standpoint, but there can be spread strategies, or there can be combination strategies. Combination strategies are strategies which involve a combination of call and puts, which can be like straddle, one call, one put at the same price, strip, one call and two puts at the same exercise price, strap, two calls and one put at the same exercise price, and strangle, which is, let's say, one call and one put but at different exercise prices. These are strategies to be entered for investors who are not in a position to decide whether the price will go up or go down, but they know that the price will go up significantly or go down significantly, like election outcomes. We don't know. If a particular outcome is there, then the price will go up significantly. If a particular outcome comes, the price can go down significantly, but we don't know who will win. Then straddle is a good choice. Strip is if you have a higher weight for a price falling. Strap is if you believe there's a higher possibility of the price rising. And strangle is different exercise prices taken so that you can save on the premium. There are other spread strategies as well, like butterfly spread, bull call spread, but they are not really important from an exam standpoint. A very important part over here will involve option valuation. When you look at option valuation, there are three types of valuation. There is theoretical option value, there is the binomial value, and then there is the Black-Scholes valuation. The best method is the Black-Scholes valuation, followed by binomial, followed by theoretical option value. How will we know which method to follow? Well, if you see data about standard deviation, volatility being given, you see Black-Scholes. If standard deviation or volatility is not available, but up move and down move prices or probabilities are given, then you take the binomial. If up move, down move probabilities are also not available, then you use the theoretical option value. Theoretical option value is nothing but the call option or the premium that you have to pay today equals, in case of call option, spotted expiry minus the present value of exercise price. Premium has to be paid today, spot is the price today. We don't forecast the price, we say that exercise price is there in the future. So if I were to find the present value, then how much is the premium to be paid today? In case of put option, it is the present value of exercise price minus the spotted spot today, S0. You don't take SX because you don't know how to predict SX. In binomial model, you have only two possibilities. The price can go up or the price can go down. These will be given to you. There are three ways in which you can solve. There is something called as a replicating portfolio. There is something called as a risk neutral portfolio, and there is something called as a riskless hedge. So in all of these are methods which will help you to find the value of a call. The most easiest, in my opinion, is risk neutral probability. However, you can use either of these. Just to give you a glimpse, in a replicating portfolio, the essence over here is you create a portfolio which replicates the payoff for a call option, and as a result, while you are creating the portfolio, you say that let the number of shares in the replicating portfolio be X and the borrowing taken be B. Based on that, you create a replicating portfolio today which has the same payoff as a call option 1 year later, for example. And because the payoff is similar to a call option, you can formulate a simultaneous equation, solve it, find X, find B, and based on that find the premium or find the amount that you will invest in the portfolio today, which is same as a premium for a call option. Second, if you look at the riskless hedge, in which case how many shares should you kind of buy for every call option sold? Because it is a riskless hedge, then after 1 year, the values under both cases would be the same, and hence you will equate the two positions, the up and down position, and from that you will find X. Once you find X, you will find the value of the portfolio after 1 year, and present value of that will be the value today, from which you will figure out how much is the C0 or the money that you would have received on selling the call option. And last, which is the most easiest in my opinion, is the risk neutral probability, where you take the probability of an up move as P, down move as 1 minus P. The value of a share today is the present value of all the future share prices, that is the present value of S1, who has a probability of P, and S2, who has a probability of 1 minus P, divided by 1 plus R. So this will help you in finding P and 1 minus P. And once you find the P and 1 minus P, you can say that, well, the value of the call today will be the present value of future call payoffs. That is C0 equals C1 into P plus C2 into 1 minus P upon 1 plus R. This will help you to find the call option premium today. Complex questions can involve having a multi-period binomial, in which case you start from the right hand side and slowly come to the left hand side. There may be European and American options. In case of European options, you will not have exercise at the intermediate nodes. In American options, you can have exercise at the final as well as intermediate or the beginning nodes as well. Next, you can have Black-Scholes method. Now this is very statistical and calculative method, where you will have call today. So C0 equals to, let us say, S0 into something called as ND1 minus the present value of exercise price using continuous compounding into ND2. So how will you find these values? Well, there are 5 steps that we prefer that you do. First, you calculate something called as natural log of S0 by XP. Natural log is log to the base E, and hence you will have to first convert it to the log to the base 10. So over here, let's say the spot price is 400, the exercise price is, let's say 350, in which case 400 divided by 350 will come to 1.1428. So you will say 1.1428, but this is a natural log. So you apply change of base rule and you say, okay, this is log of 1.1428 divided by log of E. Log of E is 2.71828, and hence whatever is the log value that you get in the numerator divided by the log value of E, which is 2.71828. The log value of E is, I think, 0.4343. You will get the natural log value. You do not take any anti-log over here. Then you go to the second step, which involves calculation of D1 and D2. D1 on this is calculated as the natural log of S by X plus R plus the variance divided by 2 into T upon the root of T into standard deviation. And D2 is D1 minus the denominator that was used over here, that is the root of T into standard deviation. Once you have D1 and D2, you will look at the normal distribution tables. In the normal distribution tables, you will have to take the value from the left tail up to D1, left tail up to D2. Usually you get the tables which is a half table, which is from the center to one of the tails, in which case D1, if it is positive, will fall on the right hand side of the curve. D1, if it is negative, will fall on the left hand side of the curve. You will have to properly look at the normal distribution curve and take the value from 0 comes in the center. So value from the left hand side to D1 or D2 as the case may be. Once you do that, you still have to find e raised to RT, which you can do by taking log and then anti-log. And once you have all of these ingredients, that is 3 ingredients you need, n of D1, n of D2, which comes from step 3, e raised to RT, which comes from step 4, and then you can apply this in your Black-Scholes formula. This requires a lot of practice. And lastly, there is something called as option creeks, which is largely for theory, but it is relevant for your understanding as well. Over here, you're trying to find the sensitivity. You're trying to find that why should the call option premium change? Well, it should change if the underlying share price changes. So this is measured by delta. Sometimes the delta will also keep on changing, like you have duration and convexity. Duration changes, that is measured by convexity. So delta itself can change, which is measured by gamma. Other factors due to which your call option premium can change is if the volatility changes, if the standard deviation changes, which is measured as vega, V for volatility, V for vega, or the time period changes, T for time, T for theta, or the rate of interest changes, R for rate of interest, R for rho. So these are basically called as option Greeks, which try to measure the sensitivity of the option premium to a 1 unit change in either the share price or the delta itself or the volatility or the time to maturity or the rate of interest. Remember, exercise price does not change, and other than that, all other factors are kind of considered here. Okay, so that takes care of derivatives. The next chapter is on to interest rates. So next we have interest rates. in interest rates also you have this 4 standard products for derivatives, the futures, forwards, options and swaps. However, when we look at each of these products, there is some speciality. So when we look at interest rate futures, futures have to be tradable on the exchange, but the problem in interest rate futures is that an interest rate is not an asset or a liability. Basically, it's an interest income or interest expense. And hence, it is very difficult to find a price for the interest rate. So how do we work around this? Well, interest rates are almost always embedded inside bonds, and hence in order to trade you can easily have bond prices. So over here you can determine bond price. However, we don't want to buy or sell the bond. Okay, that's fine, but for convenience, interest rate futures are denominated in terms of bond prices. And how are they quoted? Well, they're quoted as 100 minus the rate of interest, 100 minus the rate of interest. So if the rate of interest, for example, is 6%, even if it is per annum, then the bond price will be quoted as 100 minus 6, that is 94. If the interest rate changes from 6% to let us say 8%, then the market price of the bond for the purpose of interest rate futures will change to 92. 100 minus 8 is equal to 92. And hence, if I want to figure out the gain or loss, the selling price and the cost price can be compared, that is 92 and 94, and a gain or loss can be determined. So over here, you have to look at the terminology. 100 minus the interest rate will give you the bond price. Secondly, the terminology in terms of the instruments. So for example, you're sitting today in the month of, let us say, October, and you want to do a borrowing in the month of March, 6 months later approximately, in which case you can, and you want money only for 3 months, let us say for the summer season, that is April, May, June or something, in which case you can enter into a 3-month March future, which means a contract which is for a borrowing of 3 months, but a borrowing which will be taken, let us say, in the month of March. So this is a 3-month March futures. Okay. Now, what are the steps that you have to do? First step is strategy. How do you determine the strategy? You should ask yourself, am I a borrower or am I a lender? If I'm a lender typically buys bonds, invests in bonds, and hence the lender will buy interest rate futures. On the other hand, a borrower typically issues or sells the bonds, and hence the borrower will typically sell interest rate futures. Step 1, strategy. Step 2, maturity. Again, you will take the bond which matures at or after your desired maturity. So if you want, let us say, a borrowing in the month of March, you will, and you have futures which are expiring, let us say in January, futures which are expiring in May, only these 2 options. Well, you will take the May futures, because January futures will expire in the month of January, and it will expose you to potential interest rate changes which may happen in the month of February as well as March. However, May futures will be alive in the month of March. You might actually go to the spot market and take the borrowing, and then you can sell or close the interest rate future. So you will take the future which continues up to your date of maturity, and it goes beyond the date of maturity as well. And third step is the number of contracts. The number of contracts is calculated as the amount of borrowing upon the contract size. So if you need $100 million and the contract size is, let us say, $10 million, then that is ideally 10 contracts. However, you also need to look at the number of months for which you need the borrowing. Let us say you need the borrowing for 3 months, divided by the number of months in the futures contract. See, on the if you look at this equation, on the left hand side you have desired borrowing, and hence corresponding to that you will also take the borrowing tenure. Okay, so your borrowing tenure, let us say, is around 3 months, futures contract size, but then for how many months is the borrowing in the futures available? Let us say 6 months. Futures is only giving you 6 months, in which case the rate of interest in the futures will be for 6 months. You need only for 3 months. So over here it will be like $100 million upon $10 million. So ideally 10 contracts. However, the borrowing tenure is 3 months, but the futures contract tenure is 6 months. So let us say this can get adjusted, and you might actually need only 5 contracts to hedge, because 10 contracts for in the futures market will be for 6 month tenure. You don't want to cover interest for 6 months. You want to cover interest only for 3 months. And as a result, like in EPS, you have equivalent number of fully paid shares. Similarly, we can say equivalent 5 contracts should suffice. So step 1, strategy. Step 2 maturity, step 3 number of contracts, and in step 4 you will look at the settlement. At the time of settlement you will go to the spot market and take the borrowing, on which you will incur interest as well. So there will be interest if you are a borrower, cash outflow; if you are a lender, cash inflow, and then there will be a gain or loss. This gain or loss is calculated as selling price. So for example, you are a borrower, you will sell. For example, you are selling at 94 the bond, that is 6% was the interest, and when you are buying, the interest rate has gone up. It has gone up to 8%, that is 92. So 94 minus 92, but that is 2% into, you will have the futures value, let's say $10 million, into, let us say, 5 such contracts, into, let's say 6 by 12, which is a futures contract, tenure. In which case you will get the gain or loss on futures plus or minus the cash inflow or outflow on account of interest will give you the total effective interest cost. You can also calculate this effective cost in a percentage terms if you want to. So you can take the effective interest in rupees divided by the amount of borrowings, and that will give you the effective interest. You do 12 by M, so that is percentage per annum. So this is on interest rate futures. Then there is interest rate FRA. FRA is very similar to a future, just that in case of a FRA, you enter into a one-to-one contract, let us say with the bank. In which case, when we are looking at a FRA, you don't need a bond price. You can directly deal in interest rate. So your piece of paper will mention at what rate you are agreeing to borrow at a future date or lend at a future date. Now the thing is, most of the times banks who enter into interest rate FRAs don't give you actual lending or borrowing, and hence even over here settlement in a lot of times happens on a net basis. So over here you need to figure out the strategy, what you want to do, whether you want to buy or sell. Here remember, the strategy is opposite of that of futures because your underlying is different. Here your underlying is interest rate directly, not the bond. So we will ask ourselves that what will a lender do? Well, lender receives cash on account of interest. You receive cash for something that you sell, and hence you must be selling interest, so you are receiving cash. So a lender sells FRA. On the other hand, borrower pays cash. You pay cash for something that you buy, and hence a borrower must be buying interest. So over here, borrower buys FRA, a lender sells the FRA. The FRA terminology over here is slightly different. So for example, if it is something like a 6 by 9 FRA, 6 by 9 FRA means if you want to take a borrowing after 6 months for a period of 3 months. Like in case of futures, if you are sitting in October, if you take the 3-month March futures, it means you are taking a borrowing in March, that is after 6 months for a period of 3 months. In case of FRA, you will not call it as 3-month March FRA. It is called a 6 by 9 FRA, which means after a period of 6 months, you will take a borrowing of 9 minus 6, that is 3 months. That is how you will read the FRA terminology. Acha. So this is about terminology, the strategy we have discussed, and over here in FRA questions, the institute might sometimes ask you to calculate the theoretical FRA rate. On what should be the theoretical FRA rate? We have even discussed this in valuation. So let us say over here FRA is a forward rate. So you are getting a 2-year bond at 12%, and a 1-year bond is available at, let us say, 10%. That means for the second year, what is the rate? We are saying that 1 rupee that you start now should become the same after 2 years, that is 1 plus x. If you solve this, this is, let's say, 1.2544, this is 1.1 into 1 plus x. Therefore if you solve, this will come to, let's say, 0.1404, that is 14.04%. 14.04% per annum will be the theoretical rate after 1 year, for a period of 1 year. This is a rate of, if I take it in months, this is a rate of a FRA 12 by 24 or 1 by 2 if you take it in years. Now you will compare this with the actual bank rate. So if the bank is giving you an actual forward, for example at 15%, or if it is giving you at 13%, there is an arbitrage opportunity which you can exploit by comparing this theoretical FRA rate with the actual FRA rate quoted by the bank. Time value adjustment. Now this is where things get a little complicated, in the sense that institute solutions have been slightly inconsistent between FRA and futures. So here what we are commenting is only and only based on the general institute solutions in the study material, RTPs, as well as past exam questions. If it's an only futures question, then you will not do a time value adjustment. If it's an only futures question, institute does not do that, so we avoid doing it. If it's an only FRA question, then institute does a time value adjustment. Sir, what do you mean by time value adjustment? Well, if the FRA rate is 6% and let us say at closing the rate has become 7%, so 7 minus 6 into let us say 100 crore is the FRA amount, so this is 1 crore. But this 1 crore is to be payable when? Well, it is going to be paid at the end of the loan tenure. However, people don't want to wait till the end of the loan tenure because interest is paid at the end. So if you want to settle it immediately on the fixing date, on the date when you are going to take the loan, that date itself you want to settle it, then 1 crore का आपको present value लेना है. You will take the present value of 1 crore discounted discounted at the rate which is prevailing on the fixing date, let us say which is 7%. Okay, but if it's again a FRA and a future question, institute does not usually do the time value adjustment, and hence we will also avoid doing the same. Okay, so this takes care of the time value adjustment. Next we go to interest rate options. Now within interest rate options there are two main products. There is interest rate cap, there is interest rate floor. As the name goes, cap is the maximum rate of interest, floor is the minimum rate of interest. A cap is typically taken by a borrower to protect from rising interest rates. A floor is typically taken by a lender to protect from falling interest rates. A cap will be exercised if your actual rate, let's say like LIBOR, crosses the exercise rate. So for example, it's greater. So if your exercise price is 10% and your LIBOR becomes 11%, 12%, 13%, that is when the cap will get exercised, whereas the floor will get exercised if the rate is below. So if your floor rate is for example 4% and the market rate becomes let us say 3%, 2%, 1%, that is when the floor will get exercised. So for the option holder, the cash flow on account of a cap will be at the fixing date or interest date. You will calculate as the difference between the actual LIBOR, for example LIBOR is 12%, minus the reference rate which is 10% into let us say the reference borrowing is 100 crores into, for example, if it is 6-month borrowing, 6 by 12, or you can take it in days as well. In case of floor, it is the other way around. So if the rate becomes 2%, then you will compare 4 and 2 into 100 crores into 6 by 12. Now, even in case of caps and floors, the problem is the premium is generally paid upfront. However, these amounts are paid at a later date, and hence you might need to find the annualized premium, whereby you will convert your premium into an annuity. So for example, your cap is a 3-year cap. The rate of interest prevailing today is for example 8%, and you have to pay upfront 2 crores. Then 2 crores today is equivalent to how much per annum? So your formula is the premium upon the present value annuity factor, let us say at the rate of 8% for 3 years. This will give you the annualized amount. I don't know the number exactly, but let us say hypothetically, let us say it comes to 0.75. Then 0.75 per annum or 2 crores today is one and the same, and hence you will get the effective cost on each interest payment date. There's also a product called as collar. Collar means you are trading in both the cap and floor together. So for example, a borrower would typically want to buy the cap, but buying the cap will come attached with the premium. So it wants to minimize the premium cost, so it might sell a floor. If it is believing that the interest rates will not go down, it will sell a floor and recover some of the premium. Or a lender will typically buy a floor. It does not believe that interest rates will go up, so it might sell a cap. This is done in order to protect, or not really protect, but reduce your interest cost, reduce your premium cost. It's a combination of cap and floor, that is called as a collar. Now the last section of this chapter involves swaps. This is something which is important, as come I think a couple of times in your main exam as well. So there are a few steps. If the swap has already been designed and given to you, nothing like it. All you have to do is try to put it in a diagram, and once you put it in a diagram, try to calculate the effective cost. The net cost of financing will be the cost that let us say you are paying to your bank plus the cost that you are paying to the swap counterparty minus the amount you are receiving from the swap counterparty. That's it. So if a swap has been designed, it's going to be complicated when you read the question, but you should put that in a chart and then take the total. That will give you the net swap cost. Okay, now what are the 4 steps that you have to remember while designing an interest rate swap? So when you design an interest rate swap, step number 1, you will first try to find the cost savings. How do you calculate the savings? Well, you will try to calculate the cost for a particular borrower. If they go and directly borrow, they don't enter into a swap, they go to a bank, they directly borrow. You want fixed rate, you go to a bank, directly borrow the fixed rate. What is your cost? Compare that with the cost if you enter into a swap. That is, you find the net cost of financing. So you will try to take the difference and find the total savings. Sometimes you can, if you don't know what is the swap, you can take the total cost. You can say that, okay, if I go and borrow directly, my counterparty goes and borrows directly, what is your total cost? Achha, if we swap, instead of I borrowing at the fixed rate, if I borrow at the floating rate, the counterparty instead of borrowing at the floating rate borrows at the fixed rate, then what is the total cost? They'll give you the total savings. These total savings are to be shared. If nothing is given, they will be shared equally. If a particular ratio is given, you will take that, and based on that, you will try to find in the second step the actual cost that you should have at the level of swap. So that is the cost of borrowing under the original strategy minus the share of savings. Based on that, you will actually draw up an entire swap. You will draw a chart where you will have both the parties. You will take your actual borrowings and then you will have swap flows, but you don't know how much is to be paid. So let the fixed payment be X and let the variable payment be equal to LIBOR. And once you have done that, in the last step, you will formulate an equation where you will have those three items, these three items, your interest paid to your bank, which you will know, plus the interest paid to the counterparty under the swap. Let us say you are paying the fixed interest, so plus X minus the interest received minus LIBOR will give you, let us say, your net cost of financing. And once you can do that, you find X, you will do some practice and this will easily sail through. A couple of swaps which are there, which is, one is a generic swap, which is typically a swap which is settled on a net basis every 6 months, the LIBOR is reset, and an overnight index swap where the swap is reset, the floating rate is reset on overnight or a daily basis. Okay, so that is pertaining to interest rates. Next, you have three fairly small, compact and easy chapters, but nevertheless we'll just discuss them. First is risk management. So risk management has some theory, but the numericals, if they come, they have to be linked to a concept called as value at risk, also called as VAR. So what is the formula for calculating value at risk? Value at risk is calculated as a daily standard deviation in rupee terms of your portfolio into the Z value, which comes out from a normal distribution table. Let us say at a particular confidence level, can be 99%, can be 95% or 90%, into root of number of days. So over here, let us say you have a portfolio which is of 10 crores and the standard deviation on the portfolio is, let us say, 1%, daily standard deviation. So 10 crores ka portfolio, 1% of that, on an average the deviation will be 10 lakhs. So let us say this is 10 lakhs of deviation. But this is average deviation into Z value. You want deviation that covers 99% of the possibilities on the normal distribution curve. So there are three possible Z values: 99% confidence, 95% or 90%. Typically you will get 99%. So you can remember 2.33. The question should tell you. So you will multiply this by 2.33 into root of days. You want to find it for 1 day, then you divide square rooted by 1. You want to find it for 10 days, then you root it by 10, and that will give you the value at risk. So that's kind of it. This is there can be simple questions which are linked to this particular concept. You have to find the daily standard deviation in rupees multiplied by the Z value, which is typically 2.33 in case of 99% confidence, and into the root of number of days. Okay, so that is about risk management. Nothing much. Next, we have corporate evaluation. To be honest, even in this chapter, you don't really have any new concepts. It's just some or the other methods here or there, or simple methods. So I mean, I've just summarized 3 methods over here, but this chapter has a sum or 2 on EVA as well. It has a sum on 2 on levered and unlevered beta as well, which is already covered in either mergers, portfolios, etc. So you don't really have to bother about that. So when you look at corporate evaluation, one of the methods which can be used is net assets value, that is total assets minus total liabilities at fair values minus preference share capital, if any, divided by the number of shares. That will give you the net assets value. There can also be a multiple approach. Multiple can be based on equity, so you can take price by earnings to find the equity value, or it can be based on the enterprise. You can take the enterprise value by EBIT or enterprise value by EBITDA. You can also have earnings capitalization. On an overly simplistic basis, you can take the earnings without any further adjustments. To be honest, if you take cash flows, it will be more accurate, but on an overly simplistic basis, if you were to take just the earnings, that is PAT plus depreciation for equity, or PAT plus depreciation plus interest for the enterprise, and divided by the respective factors like KE for finding the equity value, KO, WCC for finding the firm value, that will give you the earnings capitalization. More accurately, people do the cash flow based capitalization, where you will take FCFE or FCFF as a case maybe. One can also adjust interest with 1 minus t if you want over here. That is also permitted. Institute has taken directly interest, but interest into 1 minus t can also work if tax rate is available. Lastly, there is a chapter on international financial management. International financial management is nothing but international capital budgeting, where you are evaluating a foreign currency project. Now, if it's a foreign currency project, your required rate of return, which is given in the question, typically is your Indian currency required rate of return. However, if you are investing in US, the required rate of return might be different. And hence, there are two approaches in which you can solve. One is called as a home currency approach, other is called as a foreign currency approach. Under the home currency approach, you will convert all the cash flows which are in foreign currency into the local or the home currency, and this will be done at the forward rate. If forward rate is given, you take that. If it is not given, you can calculate it using the interest rate or inflation rate parity theory that you study in foreign exchange. That means all your cash flows now are in your local currency or rupees, and you will discount that at your rupee based discount rate in order to find your NPV in rupees and decide whether the project is accepted or not. This is called as a home currency approach. Alternatively, you can also take the foreign currency approach, where you discount the foreign currency cash flows but at the foreign currency discount rate. Now, typically the foreign currency discount rate is not given to you in the question. So, how do you calculate it? Well, the foreign currency discount rate, you will say that, well, why should it be different? Well, because the inflation rate, the interest rate in the two countries are different. Well, the required rate in India, for example, is 14%. Why should I require 14%? Well, I require 14% in India because I need to compensate for the, I should at least be compensated for bearing the risk as well as the risk-free rate. So, let us say the risk-free rate in India is, for example, 6%. Then I'm not expecting 6% on 1 rupee that I invest, I'm expecting 14%. Then the remaining is, let us say, attributable to the risk premium. So, over here, if I take 1.14 upon 1.06, let us say I will get approximately 7.5% as my risk premium. 0.075 or 7.5% is my risk premium. Now, if a business is risky in India, typically it is also risky in the US. And hence, we assume that the risk premium across the world is the same. So, in the second step, we say, okay, the risk premium in India and US is the same, but the inflation or interest rate in the US is not the same. Let us say the interest rate in the US is just 2%, but the risk premium is still 7.5%, and hence 1.02 into 1.075, let us say approximately 1.0965 will give you the required rate of return in the US. So, if India it is 14%, in the US it will be 9.65%, and you will discount the foreign currency cash flows at this 9.65% to find the present value in dollars. Again, this is present value, NPV in dollars. It is as if someone were to give you $100 over 3 years, or they were to give you an X dollar amount today, and hence you will convert that at the spot rate. So, your NPV will be converted at the spot rate to get it back into rupees. So, long story short, home currency approach, convert the foreign currency cash flows into the home currency at forward rates, and once you have done that, discount it at the Indian currency rate to find the NPV in rupees. Under the foreign currency approach, you discount the foreign currency cash flows at the foreign currency discount rate. The NPV that you get is in the foreign currency, convert it at the spot rate and get the NPV in rupees. Okay, a few key adjustments that are possible in a capital budgeting question. First can be on something called a sunk cost. Sunk cost is cost which is already done, like assets already purchased or market survey already done. This has to be ignored for the purpose of capital budgeting. Second, apportionment of existing overheads. So, if you have an existing factory or a common asset and you're just apportioning the overheads, if you take a new project, that apportionment ratio can change. But you're not spending a rupee more, and hence this is just an allocation. So, existing overheads which are allocated should be ignored. Sorry. Then you have working capital. When we are looking at working capital, working capital should be a part of your investment when you are investing money initially. Working capital should also be a part of your recovery, like fixed assets. You invest money, but if nothing is given, the salvage value of fixed assets is assumed to be 0. But working capital is circulating, and as a result, you buy, let us say you are setting up a showroom, you will need money to buy the fixed assets, but you will also need money to buy cars which are to be displayed in the showroom. You will sell those cars, get new cars, sell those cars, get new cars, and so on and so forth. This will continue till the last year when you will sell the cars and the money will be released. So there will be a release of working capital as well, which is a hidden adjustment where there will be a cash inflow at the end. Again, if there is inflation, then working capital requirements also increase each year due to inflation because it is circulating, rotating. Certain questions can come along with inflation. If there is inflation, you need to remember that there are two terms. There is real cash flows and there is nominal cash flows. Real cash flows are ignoring inflation. Nominal cash flows include inflation. So if your discount rate is typically the nominal discount rate, which includes inflation, because you take the risk-free rate in the KE calculation. So risk-free rate includes the effect of inflation. So usually your discount rate includes inflation. So your cash flow should also include inflation. So if the cash flows given in the questions are real cash flows, you will have to adjust inflation, make it nominal and then discount it by the nominal discount rate. Or if the cash flows are real cash flows, but the discount rate is nominal, then you will have to ensure that you discount the real cash flows at the real rate or nominal cash flows at the nominal rate. Okay. Certain questions can come pertaining to modified IRR. You might have studied IRR in your industry. A modified IRR just tries to make a modification that it says that if these cash flows that I receive in each year, if they were to be reinvested, at what rate? Well, at the cost of capital. Then what will be the value of each cash flow at the end of the project? So you find the total cash flows at the end of the project and then you compare it with the initial investment and then find a rate of return, which is called as the modified IRR. And then lastly, adjusted NPV or adjusted net present value. So when we are looking at adjusted NPV, this is to be done only if it is asked in the question. Here we say different cash flows carry different levels of risk. In a particular project, it is wrong to discount every cash flow by the same level of risk. Like for example, you might have entered into a mining project. The revenues, expenses on a mine are subjected to higher rate of risk as compared to, let us say, I have to pay interest. Now that is subjected to a different rate of risk. And hence interest or principal cash flows can be discounted at the rate of return only for only relevant against the financing aspect, whereas these operating cash flows can be discounted at a different rate. So this will give you adjusted net present value. The respective cash flows getting discounted at the respective rate. Okay, so I guess that should be it. I hope this session has been helpful. I'll share the document as well for you. It will help in your last day revision as well. You can download it from our Telegram channel. If you have liked the video, please do share and subscribe to our channel. Let us know if you need any other help, any other videos which you think can help, and I'll be happy to help. Wish you all the very best. Do well, keep your focus, keep the rhythm on, and we are sure you're going to be able to crack it. Good luck, goodbye, take care.